I'll start talking more here in a couple of minutes. You're going to see my mouse move around because I'm going to update some of the charts. And for those of you that read the blogs, you can go ahead and log in and read the update. I'll talk more about this at 8:30, but it's really interesting. We came within 2 ticks and 2.25 ticks of the 5,000 round number. And my biggest thought today is, for one, 5,000 is going to be an important magnet. I think the odds are pretty low that we're just going to test it within 2 ticks, sell off, and that's the end of it. More likely, we're probably going to hover around 4,000 for some time. Even if we go all the way back down in the open of the year, I still think we're going to spend a lot of time at 4,000. And the reason for that is, if we just look, I said 5,000, I said 4,000, I meant 5,000. The reason for that is, if we look what happened at 4,000 over here. So here's 4,000, and we spent a lot of time around 4,000. And I think that's what's going to happen with 5,000 as well. The other reason for 5,000 is 5,000, it's basically the all-time high. We have such a tight bull channel right here that we're probably going to have to go sideways for a long time. I say a long time, but it's certainly 10 bars, maybe more on the weekly chart. That makes me think that this is not going to be the high, but I wouldn't be surprised at all if maybe we form a bear bar closing on its low today. Maybe we test down to January 30th and go sideways. By the way, I'm updating the blog for the euro dollar right now, and pretty interesting. Big bull bar, reasonable buy, but it's a wedge. Several lows, 1, 2, and 3, and then maybe a failed breakout of a wedge, or 1, 2, 3. Big bull bar closing on its high, and a big bear bar. So a lot of the bulls who bought here are trapped. And so the target for the bears is the December low. And you can see we're really close to it. We have a negative gap right here. That's leg 1, pullback, leg 2, and we're really close to it. So we may have to go a little bit lower. Okay, I'm going to update some lines, but I will talk again here probably in about 5 minutes or so. So the E-mini is going to open here in a couple of minutes, about 2 minutes, and I'll talk about this more here in a couple of minutes. But the most important thing on the open is to be patient. There's plenty of time to find trades, and you do not need to take a trade in the first 5 minutes. So be patient and be ready, because there's plenty of time to find a good trade. So we're gapping down on bar 1. At the moment, a few things interesting. One, what do you notice about the high of bar 1? The high of the bar is the exact opening tick, and that makes me think that there's probably a 90% chance or more that bar 1 is not going to be the high of the day. Possible wedge, 1, 2, 3. And the reason bar 1 is not going to be the high of the day is look at the daily chart. How many times do you see the open be the exact high or the exact low of the day? It's pretty rare. Daily chart, we're testing 5,000, and right now, today has the potential to possibly be an inside day. Let's make this a little bit bigger. But even if it is an inside day, there's probably buyers around the February 1st high right here on Thursday, and we're probably going to go mostly sideways. As I said earlier, I think 5,000 is an important magnet, and we're probably going to test 5,000 several times. If we go to even if we sell off all the way down here, the low of January 31st, I still think we'll probably get to 5,000. Weekly chart. Here is, so 4,000 is right here. And look how many times we tested 4,000. We spent a lot of time at 4,000. Here, rallied, we went below it here, rallied, went below it here. Obviously, the price has been adjusted, so 4,000 could be a little bit lower, but the point is, we had a hard time getting away from 4,000, and I think it's going to be similar to 5,000, just because this is an all-time high. I doubt we're just going to sell off and plunge down. More likely, we're going to have to go sideways for a lot of bars. A lot of bars on the weekly chart, that could easily be 10 bars, 12 bars. So if we go sideways for 10 weeks on the weekly chart up here, that would increase the probability of, give me just 1 second. So anyways, if we go sideways for 10 weeks, that's several days on the daily chart. But the point is, we are probably going to be sideways around 5,000 for a while. So bar one is, let me just fix that. Bar one, bear bar, closing above its midpoint. Just ask yourself, what's the probability that if you sell the close here and put a stop above bar one, you won't get stopped out? Even if we fall below bar one, I suspect we're going to go above the high of bar one. So there's probably buyers below one, and we're probably going to bounce. What are the chances that we get to 5,000 today? I don't know. I think the bulls are going to have a hard time getting there. But the most important thing on the open is to realize that there's still 80 bars left. And if we wait for 5 or 6 bars before doing anything, you're going to have a lot of information. And a lot of information, the more information you have about the structure of the day, the higher the probability that you can take a trade and catch an extreme. Catch the high of the day, catch the low of the day. So if we look at yesterday, trading bar one is rather low probability. There's probably sellers above, buyers below. Same thing with bar two. But by waiting for several bars here, the chances of seeing the low of the day or the high of the day go up by a pretty good amount. Maybe there's probably 60% chance, certainly at least 50-50. Here, the reason I'm saying 60 or 50-50 is lots of buy climaxes on the prior days. There's added risk of a sell-off. But buying here, stop below one, high probability that the market's going to go sideways or up. Obviously, at some point up here, the probability of seeing the low of the day is dramatically higher. So in bar one, yes, there's probably buyers below one, buyers around where the current bar is, but you can also just wait for a bull bar. And even waiting for a bull bar does not make it high probability to buy above. More likely, we're probably going to go sideways here. I'm going to turn the screen off and pull up the encyclopedia. I'm going to turn the screen off and pull up the encyclopedia. Consecutive bear bars, but a close above the low of bar one slightly lowers the probability of selling. But consecutive bear bars increases the risk of at least a small second leg down. I'm going to turn the screen off one more time and pull up some slides. Now, I mentioned that the open of the day is the high tick of the day. High probability we're going to go above the open, but it can happen later in the day. It does not have to be right now. As far as buying here and scaling in lower, you probably will make money, but if you're buying the low of one, you can see traders that bought it. The low of this bar is The low of 1 is 65.5, and the high of the current bar is 68.25. So the market's gone up 2 points, allowing them to make a scalp, but it hasn't gone up 3. If bar 3 is another bear bar closing on its low, traders will have to think about the possibility of downside breakout. So that's my concern about buying with limit orders on the open. The probability is high, but it's not all that easy. I still think, again, we're probably going to go above the open of the day. So if you're a bear and you sold the close of 2, what do you do if 3 is a bull bar closing on its high? I think the always in bears probably exit above the bar. It's really important, I can't stress it enough, to be patient on the open. So here's an example where the open is the high of the day. And this is pretty similar to what we have so far. And you can see it happens about twice a year. Now, is it twice a year? Is it 3 times a year? Some years, is it 4 times a year? Who knows? The point is, more often than not, the open is not going to be the high tick. And the reason for that is, and this is also important to realize, data is not always accurate. So the way you confirm it, which I'll check in a few minutes, I don't have real-time data on the CME website, but I'll check in about 15 minutes and see. Or less than that. But the point is, the odds are this is not going to be the high. You can see, pretty rare. Somewhat of a similar. This is the risk that the bears face, that the bulls face. But you can see we're not getting that. So the odds are high, we're going to go above bar 1. Probably a 95% chance. But again, we can get several legs down if I go back to that example. So it's possible that we get a couple of legs sideways to down. It's possible we get down to the 30, the 40 low from yesterday and then reverse up. But at the moment, bar 1 makes me suspicious. I'm going to check the CME website and verify. I just saw a message from Richard saying that there is a tail on if you have access to the full data. And that's pretty common. What you have to remember is most data is going to be sampled. So just because my trade station is showing that, well, actually, let me see something. Give me just 1 second here. That's actually fairly odd. So on my trading computer, I just looked, and there's a 1-tick tail on bar 1 with my trading computer. But on this computer, it's showing the high and the open the exact. Here's the 830 bar. The high is 73 open, 3 even, and the open is 73 even. So this computer, according to the CME website, is actually right. The CME website is showing, you can see it right here. Whenever I question the data, I always take a look at the CME website. And if we look at it, you can see at the top of the screen, the open, 73 even, the high, 73 even. Now, would it matter if the market had a 1-tick tail? It might slightly increase the probability that we've seen the high of the day, but slightly. Whenever you're taking a trade, whenever you're selling something like the close of 2 and you're putting a stop above 1, you know it's a low probability trade. Just look at this. So the range, the close of 2 is 67 even, and the high of 1 is 73. So let's just round it off and say that's a 6-point range. How many times has the range been 20 points? Just about every day has a range of more than 20 points. And the reason I say that is if you're selling here and putting a stop up here, that's giving you a great risk-reward trade. You could sell this close at 2, stop above 1, and who knows, maybe you get lucky. Maybe you catch the extreme of the day. So let's find some examples. We have a gap down. Whenever I'm using the encyclopedia, the first thing I would do, just so everyone knows, spend some time learning where everything is. And that's after you've studied the video course. You can't just get the encyclopedia and have never studied the course and act like it's going to help. So if we go to gap down, bear trend from the open, low 1, so breakout pullback sell on bar 4, but low probability sell below 4. There's probably more buyers below than sellers. And the bears, they obviously want a surprise breakout and a test of a 39 low. This is possible, that this is a possible parabolic wedge. It doesn't look like it, but we sold off on 76, pulled back, sold off on 80, pulled back, or 79, pulled back, sold off on 1, pulled back. But it's not really all that great. What about buying below bar 4? You can, but again, my concern, gap down, follow through 1 and 2. We may get a small second leg down. So if you're buying below 4, I think you have to buy more below 3. Sometimes if I take that trade, I might buy the low 4, stop below here. Sometimes maybe put a stop down here, twice the range of the bar. But if I'm ever buying a low 1, remember low 1s lead to trend resumption. And if I'm fading a low 1, I'm betting that there's disappointed bears who sold anywhere down here, scaled in, and they're buying back short. So if I'm buying the low of 4, I'm betting on a scalp, maybe the midpoint of the bar, maybe a small profit. But the problem is the range of this bar is about, let me use my other computer. The range of this bar is 4 points. One of the problems with TradeStation 9.5, my only complaint with 9.5, the old platform, is it's really hard to read the data window whenever it's next to the price axis. Other than that, I'm really happy with 9.5. But anyways, buyers below for a scalp, but I suspect we're probably going back to the open. So if I had to do anything below 4, I'd be long. And like I said, a stop, either a measured move down of the bar or maybe 2 times the range. At the moment, I'm flat. This is a good slide to learn, 7.1. So if you go to part 6, look at slide 63, gap down, bear trend from the open, 3 possibilities. It's the opposite for bull trends from the open. 20% chance that we get a bear trend from the open lasting all day. So there's 20% chance that today is going to be a bear trend from the open in general. And then you can see this slide is most important. If we get a bear trend from the open, which we don't clearly have right now, 60% chance that will evolve into a trading range. Now the bears, they want something like this, sideways, sell off, trading range, maybe a second leg down. Not quite what we have today. Maybe something like this, but not even, still not like what we have today. The bears, they're hopeful that we form a tight bear channel. What do I think is going to happen? I think we're evolving into a trading range. Whenever you look at the lows here on the open and you want to see where support is, look to the left. Look for breakout points. So we have the high bar 41. If you're a bear, if you remember I said on this bar Friday, I thought the bears would get a second leg down, and they never got it. Instead, the bulls got an upside breakout, trapping, and it trapped the bears. So anybody who sold the high of bar 41 right here, got trapped on 42. And then there was follow through on 42. So if you're a bear and you sold here and you scaled in, you got trapped. I was one of those bears. I sold on the way down. I took part off during this bar. I think I took, 3/4. But let's just use round numbers. If I was in 3 contracts, I took 2 off here and I was long 1. So 33% of the position. And then when this bar rallied, I ended up, I can't remember where I got out here, somewhere in here. But the point is, strong enough breakout for a second leg. So all these bears here that sold got trapped into a losing position. And that will be a magnet later on. And that's in part why we're going sideways here. Whenever you're thinking about the market cycle, sometimes it can be helpful to just zoom out. You can even go to a bar chart if you want. We've been in a bull trend. We had a trend line break, rally, a deeper trend line break. So what's the chances that this is the start of a major reversal? It's probably not the start of a major reversal. More likely, it's probably a minor reversal. So it's a trend line break. Several ways we can draw a trend line. Chances are it's going to evolve into a trading range. And that's another reason why I think we're going to go above bar 1. So as far as being short, I would not be short at this moment. If I'm going to sell fairly low in a trading range, I'd rather look to sell a move that's stronger. Open gaps here and here, you can argue that, but this looks like a leg in a trading range, and legs in a trading range usually reverse. 5,000, probably too far away. By the way, one thing I often do, there's 2 toolbars that I like to have. One is, someone gave me this. It is, I'll copy the link here in a minute, but you can see, I can click on this Fed Watch tool, and it just tells me when the next FOMC meeting is. So sometimes, maybe once a week, I'll just click on it and remind myself, okay, 44 days, so don't have to worry about that. The next thing I do, and there's several websites. You can use Market Watch. Bloomberg has one. Look at the market calendar, and I'll just scroll to the February the 5th, glance at everything. So there's a 10 o'clock Eastern time, 9 o'clock Central time. So there's a report in 3 minutes. ISM services, not one that I typically pay attention to, but typically what I do, if there's a report at 9 o'clock, I try and be a little cautious and be a little bit, sometimes I'll exit the trade. So if I'm long, and I haven't done anything yet on the open, if I'm long, maybe I just exit the trade and wait for more. Part of my problem with being long here, tight bear channel on the 15-minute chart, so I suspect we'll have a minor reversal. Crude oil. I took one trade on crude oil this morning. I bought the follow through here and scaled in lower and scalped out during this outside up bar. I did sell. I sold a pullback of this bar right here. Let me make these bars a little bit bigger. I sold a pullback of this bar here, but it didn't fill my target. Ended up getting out a little bit better than I made 4 or 5 cents. Ended up just getting out break even. For one, it was getting a little bit closer to the open than I'd like, and I had to step away from my computer. And I missed all of this. But obviously, strong breakout. So what do you do here? I think it's best to wait for a swing trade. Wait for a breakout up or down with follow through. The bulls, the bears want a double top bear flag, measure move, and then a sell off. So they want to break out, pull back, and a sell off. More likely, again, we're probably going sideways here. As far as the 15-minute, as far as somebody asked on crude oil, how do I trade it? Do I look at a 15-minute chart? Do I look at a 5-minute? I look at both 5 and 15. I more often probably trade a 15-minute chart of crude oil than a 5-minute. And the reason being is it allows me to take a trade, maybe sell the close of this bar, which again, I haven't done anything over the past 30 minutes in crude oil, but I can sell, put a stop up here, trade small enough where I'm comfortable, and then just watch the E-mini. Forex, my default for Forex, I like trading 30-minute charts and 60-minute charts. 30 minutes is kind of my smallest. Sometimes I'll trade a 15-minute chart of Forex. When it comes to Forex, I really want the minimum scalp to be about 15 or 20 pips. So I want the average bar range to be about 15 pips, at a minimum 10 pips. And that rules out most 5-minute bars. So you can see lots of bouncing up and down. Bulls want a double bottom with 7 and 3, and then a decent bull bar closing on a tie. But we're not getting that. Really odd. My trade station on my other computer looks different, the 5-minute chart, than trade station on this computer. Bar 6 is a bull bar closing on a tie, and bar 7 immediately sold off. So there's a data discrepancy on my trading computer, but I believe this data is more accurate. And the reason I believe that is this computer has no tick on the open, and if I go back to the CME website, it shows the same. Now, does that matter? Not really. Does that matter? Not really. There might be a slight data discrepancy, but when I'm looking at both charts, they are both lining up. The same price. When this chart goes up in my other computer, it follows it. This does not look good for the bears. We keep trying to sell off, but we keep finding buyers below. So 7 really needs to close on its low. Sometimes on the open, I'll often take a trade around 7:30 Central Time, 8:30 Eastern Time. And if I can get a couple of trades in, I become a little bit resistant to trading right on the open. And that's pretty natural. You know, I know I talk about it a lot. I really like to wait for information, 6 bars, 7 bars, 8 bars on the open, because by waiting, you have higher probability. So this is what I'm talking about. We still have the open of the day in, and it's the high tick of the day. And yeah, yes, other brokers will show that there's one tick above, but here's my point, and here's the argument behind it. Look at the daily chart, and how many days do we see on this chart where the open is the exact low or high of the day? Open of this bar, 47 even. Low of the bar, 6.5. So here, there's a 2-tick tail. Here, open of the day, 9.25. Low of the day, 6.5. 3-point tail. Trying to find let's find a bearish example. Here, open of the day is 5 even. High of the day, 0.25. So there's a 1-tick tail above this bar. So that's an example. Let's look at this day on December the 6th. Are we always in short? I think so. It's a strong enough bar. We'll probably get a second leg down. Now, if you sell it, it's a surprise on 7. Surprises often get second legs. But if you sell the close of this bar, what do? If 8 is a big bull bar closing on a tie, that would be disappointing for the bears. Look where we are. Bar 40, double bottom with bar 7. But right now, this is a give-up bar, and it makes me think we're going to go a little bit lower. So if 7's a strong enough surprise, I think we'll get a second leg down. But you know what I'm going to say? What's the follow-through going to look like? If you sell the close of 7 and 8's a big bull bar, especially if it closes somewhere up here, I think it's worth getting out. So here's that day on the 5-minute. I am still not short. I want to see the follow-through here. So look at the 5-minute chart. This was the day where we had a 1-tick tail on the bar. As soon as we gapped up here, we immediately sold off on 1 and 2, follow through. The open of 2 and the close of 1, there's no tail. So there's aggressive selling on the open. Look at this. Does this look like aggressive selling on the open? No. To me, it looks like a leg in a trading range. But this was also my warning. the open is the high of the day. And the argument that the market's going to have to go above this high, it's a little bit lower right here. We can still, I still think we'll probably get above it, but we have a surprise, and surprises typically lead to second legs. And that makes me hesitant to looking to buy. If I was long, I think it's okay to exit longs right here and wait for a credible stop entry. Even though we're probably going to pull back, I think it's really, really tough right here. Minor surprise, typically get a small second leg down. So is this bar, the prior bar, is it a minor or a major surprise? I think it's more minor than major. Yes, it's a big bar. It'll influence at least probably the next 5-10 bars. But part of that depends on what kind of follow through we get. Here, you can call it it's a surprise. Is it minor, major? I don't know. It's more, you can argue it's probably more minor, but the problem here is it's late in a channel. So that's kind of what I see the issue with the prior bar on today. We have bear bars, but it's coming late in a channel. Here, big bear bar, late in a channel. And that makes me resistant. Plus, look to the left. Make a comment in Discord if you cannot read the text on the chart. So does it matter what caused bar 7 to sell off? Not really. Surprises often get second legs. Look where we are. Do you notice the January 30th high, which is right here? And then we also had the February 1st high right here. You have bears who sold up here and scaled in, and they're holding losing positions. And that makes me think that this will be a magnet. Again, I am not married to the idea that we have to get to the open of the day, open of the week. In other words, the open being the high tick of the day on this chart, we do not have to get back above it. And every bar that goes lower lowers the probability that we'll do that. But always in bulls who bought above 3, reasonably, it's probably low probability to do that. But if they did, they probably get out below 6. And you can see what happened a few bars later. Traders who bought above 3, their entry price is 68.75. And you can see the high of this bar, 68.5. Bar 7, the high of the bar, touched the high of bar 3. Consecutive bear bars. Are we always in short? We're probably always in short. And you can take it for a swing. But again, fairly close to support. And we're pretty late in a sell-off. So that is in part my concern here. But if I do anything, I'd be short, stop, maybe above 6 or 7, betting on at least a small second leg down. At the moment, I'm waiting for a pullback. I want to sell, but I just have a hard time convincing myself to sell this. Look where we are. Look at the moving average. There's probably a 99% chance we're going to reach the moving average today. And yes, the longer we go sideways to down here, or even down, the more the moving average gets dragged below price. But I really am not a fan. I think about it like this. What's the probability over the next hour or 2 hours that we're going to get to the open of the day, that we're going to get to the moving average? There's a relatively high probability that we're going to get to the moving average. And because of that, that makes me think that we're either going to pull back or go sideways at this price level. The market's going to have a hard time getting further away from the moving average than what it is right now, most likely. And that makes me hesitant to sell down here. The reason is, why would I want to sell here? If the odds are high that we're going to reach the moving average, why would I want to sell here? Now, The risk with that mentality is that we go lower. So just because I'm looking to sell a pullback here does not mean that I'm going to start betting we're going to get to the moving average. I suspect we'll probably pull back, and then if you do buy, you'll probably make money. But I really am not all that thrilled to be buying this. We could easily vacuum down to the February 1st high. Big bear bar 7, but overlapping bar 8. So we're in a spike, pullback, and channel. And chances are probably going to go sideways fairly soon. But no sign of a bottom yet. And that increases the probability that the first reversal up will fail. So you can see, follow through on 8, traders are selling. So what's one way you can sell this? You trade just really small and allow yourself to scale in. But I think more likely than not, we are probably going to pull back here. And that's my hesitation with selling right here. You can see crude oil pulled back a little bit. Low one short, but there might be more buyers below, and we pull back at least a little bit. Low ones typically lead to trend resumption now. So even though we'll probably pull back here for a couple of bars, I suspect that the reality is the bears who sell below this bar and scale in higher, they're probably going to make money or avoid a loss. So we have an open gap here, and that increases the risk of a bear trend day. Another thing I mentioned on the blog that's worth mentioning here is we may try and form an inside day, relatively big bar on Friday. And an inside bar would create a stop entry short. You can almost think of it as a higher high major trend reversal, bull trend, trend line break, higher high, and a bear bar. While I don't think we're going to go that far, if we do get a bear bar closing on its low, it slightly increases the risk that we get a downside breakout and a test of October 30th low, and a test of the January 31st low. I don't think we're going to go immediately lower, but I wouldn't be surprised if we do sell off here and then have to retest up to 5,000. Overlapping bar on 8 with a small body, big tails on 9 and 10. Increases the probability that we're going to pull back here. If I was short, I'd probably take a fair portion off and look to sell a pullback. But the important thing is trade small. Part of my reservation with selling here is if I'm short, what's the probability that we're going all the way down here before we pull back? I think the odds are we're going to pull back. Now, it is sell to close, though. So a lot of traders, what they'll do, they'll use a tighter stop. Maybe something like this, sell to close, stop above this bar, stop a couple points above the bar, taking a chance that we continue to go sideways to down. So again, it is sell to close. Here's the body of bar 7. We may have to reach that. Okay, we just touched the body of bar 7. Again, I think the worst possible thing you could do here is just saying, I'm going to start buying. For me, I'm just not really a big fan. It's more stubbornness. I'm not a big fan of selling this far from the moving average. Obviously, we're going lower. I think the more likely it's consecutive sell climaxes, and we'll probably pull back for a couple of bars. Therefore, I'm willing to miss out on this to look to sell a pullback. But there's absolutely zero chance that I'm buying when the market's doing this. Sell climax, bear breakout 7, overlapping bars 8, overlapping bars 9, and 10, a really strong looking bear bar. That increases the risk that this might be exhaustion and lead to a pullback. The February 1st high is important. You can see it right here. It's the bull bar from Friday's strong. You can call it a high 1 or the entry bar for the bear high 1 here. But that's probably going to act as some support. What are the chances now that we've seen the high today? You know, it's looking a lot better than 20 minutes ago. I forgot that this chart is actually delayed, and I have real-time crude oil data on my other computer. So guess what just happened right now? The prior bar went basically down here to 71. Let me check the price. The prior bar went down to 71.48 right here. So the bears that sold the low one were able to sell more higher, and the market came all the way back down here. That is just very common when you get a strong breakout. This low one was not a good sell. I'm just bringing that up because most low ones lead to trend resumption. Again, you can sell here, but you have to trade small. And my reservation is moving average. I forget where things are all the time in the encyclopedia, but I know what I'm looking for. And just because I forget what parts it's in, I can always go here. So if I wanted to find a gap down sell climax, all I would do is right here, gap down, sell climax, reversal up, and failed reversal up. So one means gap down, sell climax, and trading range. Here, gap down, sell climax, probably bear trend. Part 6, GDSX. Part 6, GDSX. So look at that bar. Are you really thrilled about selling right here? Probably not. I think the odds are we're probably going to pull back for a bar or two. So probably a good area to consider taking partial profits. Know about buying the close? I think you will have traders buying the close, but it's not all that easy of a trade. It's kind of like this right here, selling up here. It's not all that easy. The reason why it's not easy is the risk reward is often not ideal. Therefore, most traders should not take that trade. Part of the reason why I'm against most traders taking that trade is inevitably a trader will buy. They'll buy the midpoint. Let me get rid of the hand, the scaling. Traders will buy down here, and they have the right idea. They'll buy and then scalp out around the middle of the bar. But the problem I have with that logic is what traders end up doing is they will end up buying here. And they have the right idea. They'll buy, scale in. But two things will happen. One, the trader's buying here, and let's say they scale in lower. And instead of it going up, let's say there's another bear bar. So let's say it's like this. Traders sell this close. And they have an idea. If the follow through is a bull bar closing above this bar, they'll exit. And then they see this bull bar here. And rather than just taking a small loss and saying, yeah, it's not doing what I'm doing, I'm going to get out, they panic. And then they hold and they say, oh my gosh, this is going to go up so much higher, I've got to get out. And they naturally exit up here. Same thing down here. The odds are that there's a few things. One, the odds are relatively high that we're either going to go sideways here for a couple of bars, or we're going to bounce, and if we sell off, we'll probably pull back. But it's really difficult to manage the trade. Some traders might use a measure move down here, betting on a pullback lasting a bar or two. Now, part of the reason why I think we're probably going to pull back here is the moving average. We're just so far from the moving average, and we have a sell climax on 7, sell climax here on 10, probably going to pull back for a few bars. And that's often a trade I will take, buying the close of this bar. But again, as I mentioned, it's not all that easy of a trade. Now, I'm not expecting a reversal into a bull trend. What I'm expecting is a bounce. So I have a few minimum criterias right here. One minimum criteria is a test of the midpoint of the bar. And the next one is a test of the low of bar 9. So what I'm expecting, more importantly, what I'm expecting is I'm expecting for the market to go sideways for 2 or 3 bars at a minimum. So bad follow through on 11. If you're a bear, let's zoom in here. So let's pretend you're a bear. You sold the close of 10. What are you thinking on 11? If you sold the close of 10 and now you see 11, you're thinking, oh my gosh, maybe this is a sell climax. Maybe I just sold the worst price. I'm going to get out. And that is exactly what traders are doing. But 11 is not a great stop entry. And because of that, I think a lot of bulls should wait. Now, what do you do if you're a bear? I think it's okay to be flat here. And if you're not, maybe you get out a point or two above the prior bar. It's a 5-point bar, maybe you get out 4 ticks above. Okay, I just got filled. I was long. So I bought down here around the close and just took profits. Why did I take profits here? Because it's the midpoint of the bar. Again, I was not buying betting on a reversal. I was buying betting on a pullback and the start of a trading range. Whenever I'm betting on a reversal, I want a stop entry. So for me, a general rule of thumb is if I'm taking a swing trade, I need to look at the market and have a reason for always in traders to be long. And that's generally why I think traders should trade always in. So the way I would look at this day, consecutive bear bars, it's more bearish than bullish, not clear. So you can sell, stop above 2, or do nothing. Bull bar, maybe the bears exit above the bar. What do the bulls do? Bulls might buy, betting on an opening reversal. But if they do, second entry sell, second entry short, and a gap down with consecutive bear bars, I think the bulls have to get out below 6. And aggressive bears, always in bears, who are more aggressive than other always in bears, they sell below 6, maybe stop above 6. Clearly always in short, so sell to close, stop above, no reason to buy. And all the way down, there's no reason to buy. So in theory, the bears are short and they get out. Maybe they get out a couple of ticks above this bar. Let's see. So the high of this bar is 48.75 and the high of this bar is 50.5. So 48.75. It's basically gone up. It went up more than 6 ticks, so bulls were able to make a 1-point scalp. But again, a 1-point scalp when the signal bar for the bulls is 5 points, that is just not all that ideal. You really cannot risk 1 point. You really cannot risk 5 points to make 1 point. Yeah, people are saying that their computer shows different data than mine, and that might be true. But even if I look at I have data on NinjaTrader as well, and it is showing a 1 tick. My other TradeStation computer is showing 1 tick data, and this looks different. Bar 6 looks different on both NinjaTrader and my trading computer that has TradeStation as well on it. And it doesn't matter. They all look like this right now. So whether or not I'm trading on whatever data I'm using, they all look like this. But again, this is just what I gathered from Al, and the answer he gave makes the most sense. Whenever you have a discrepancy in the data, always refer to the exchange. So whenever I'm questioning the data, I'm going to go to the contract, pull up the chart, and I'm going to look at it on the chart. So here is the 5-minute chart, bull bar, and then a big bear bar. So obviously, the open is the exact high of the day, but my trade station is wrong with bar 6. Bar 6 should be a big bear bar. And here, bar 6 is not a big bear bar. Excuse me, bar 7 is not a big bear bar. Bar 6 here is a bull bar. Bar 6 here is a bear bar. So you have a low one short setup. What do you do on 12? I think it's okay to exit longs. Again, just look how far we are from the moving average. Chances are we're probably going to pull back. So gap down, sell climax, reversal up. This is a possibility. Not quite what we have today. I think this could be the actual day I learned this lesson. If I remember correctly, I wish I knew what day this was, but I think it's sometime between 2015 and 2017, or maybe 2014 and 2017. I can't remember. But looking at these tails, these bodies are really small, which makes me think that this is the E-mini sometime around 2015, 2014, 15, or 16. The reason I say that is I remember back then I was listening to Hal every day when I was in college, and I remember him talking about this lesson. We had this big sell-off, and he started talking somewhere down here. And the one thing Hal said was, he mentioned how, he said one of the most important things traders can learn about breakouts is most of the time breakouts, they're sell vacuums, and their sell vacuum test of support and buy vacuum test of resistance. And just because you see a strong sell-off, you always have to be questioning, okay, what's it testing? Because as soon as it reaches whatever target it's testing, the market will go sideways. So consecutive sell climaxes on the open can easily lead to sideways trading. But even if we do that, look what we did here. Lots of trading range price action for hours. So in essence, we entered breakout mode. We have a sell climax, reversal, and trend resumption, trend reversal. Trading ranges are always trying to get a reversal or a pullback. That's why every trading range is some form of a major trend reversal or some form of trend resumption. Kind of how, when you look in the video course, every head and shoulders top is some kind of double top or double bottom, the opposite. So you see what's going on here? Traders that sold the close of this bar are disappointed, and they're looking to get out, break even. Again, remember what I said back when I mentioned I bought the close of bar 10, or excuse me, the big bear bar, bar 10. My minimum expectation is sideways for 3, 4, maybe 5 bars. I don't think we're going to get just a strong reversal. In other words, I don't think we're going to do this right here. I think more likely we're going to go sideways. By the way, I was just informed. Richard said this was back in 2022. But it looks similar to that day. Speaking of encyclopedia and marking up charts, I think it's really important to document your thoughts and take notes. So I think I would challenge everybody should try and have their own version of an encyclopedia. So a low one short on 13, probably buyers below and more sideways. Now, can you buy here and put a stop below 9? Can you buy here and put a stop below 10? Some traders might, but I'm not all that eager to do that. I'm not all that eager to do that. Give me one moment here. I would certainly consider being out of shorts. I'm going to try and make the font bigger on the bar counter. By the way, I want to mention one thing about order placement. Whenever I'm placing an order, I really try and make it to where it's an order sends order. And basically what that, in other words, an order cancels order gets set up. So whenever I buy at the market, whenever I do anything, limit order, buy at the market, sell at the market, I always have it set up on the matrix where it will place an orders cancels order. So if let's say I'm long here and I buy at the market, I want an order cancels order to automatically populate somewhere down here, and I'll manually move it depending on what I'm trying to do. The reason for that is no matter how careful you are, the worst thing you could do is have an order in the market and not realize and then have no protective stop in. And I do the same thing with limit orders. So, or if I'm scaling in. So if I'm long, maybe, let's say I'm long here and I'm going to, or let's just say I'm long and I tried to scale in lower and didn't get filled. And now I'm out of the trade. Well, the one thing I don't want to do is have a limit order in here just sitting there. So again, probably going to start going sideways here. We're so close to the moving average. We may have to get up to the 10 high fairly soon. I want to check something. Low one short, but there might be more buyers below than sellers. Bears trying to get a second leg down, but I suspect they'll probably be disappointed. Because I suspect, for one, we're far from the moving average, and two, I think there's disappointed bears who sold down here and scaled in, and those bears will probably look to buy back some of their shorts. Obviously, trapping bulls who bought. For the bears, second leg down after the micro channel from 10. The sell-off from 7 to 10 was strong enough for a second leg, and that's why 15 is happening. So the question with 15 is 15 strong enough to get a second leg down? Or will there be buyers on the close of 15? 15 is a surprise, and surprises often get small second legs. But my concern with 15 is the consecutive sell climaxes on the day and how far we are from the moving average. Tail on 15, so some traders not eager to be selling here. But you can see, always in traders still don't have a great reason to buy. The bulls on bar 12, they were never able to trigger a buy. I do think we're going to pull back here. Again, I think this is more, if I was a bear, what would I do with 15? I think 15 is a great area to reduce your position and take more profits. This is looking like it's going to set up consecutive sell climaxes. If 16 is a bull bar closing on its high, I think it's worth exiting shorts above the bar. But I'd like the bar to get a little bit bigger. It'd be better for the bulls if they can clearly demonstrate strength and close the breakout point below 10. Again, I just don't think a lot of traders want to sell this far from the moving average. Obviously, the probability is much lower that we're going up here. I have this line drawn right here because the risk that the bulls face is that 16 is just a retest of the breakout point and that 15 gets another leg down. But again, one of my concerns here is how far we are from the moving average. It increases the probability that we may have to go sideways for several hours and get closer to the moving average. So for me, there's no way I'm selling down here. It's an issue of risk reward. If I'm short, let's say I sold the close of 15 here, my stop is above 14 and my target's all the way down here, and that's pretty far. The odds are we're probably going to pull back and get closer to the moving average. So I think there's greater than a 60% chance we're going to go here before we go here. And that's even worse probability selling above this bull bar. So that is why I'm not a big fan of being short here. The problem is stop placement. If you're a bear and you sell above 16, what's the probability we're going to go here before we go down here? And I think it's at least 50-50 for both the bulls and the bears. And that's bad risk reward for the bears. So this might be a final flag. You can see, is this the kind of follow through selling you want to see if you're a bear selling the close of 16? Of course not. Okay, always in bears. I think it's worth getting out here on 16. Too much risk that we get a reversal and a test up to the 15 high, 14 high, and maybe closer to the moving average. I need to fix something on this chart. I messed up the January 30th high here. That's why I like to lock trend lines in place, especially ones that are from several days ago. Bears, they'll try and prevent the bulls from triggering the buy. Okay, looks like the bulls already triggered the buy, so that's good for the bulls. I would get out of shorts above 16. To me, there's just too much risk that we get a couple of legs sideways to up. Now you have some trapped bears who sold the close of 15, disappointed 16, trying to get out, break even. Getting closer to the target, close of 15. The follow through is important. The bigger the entry bar the bulls can get on 17, the greater the probability that we're going to test higher. Even if the current bar is a bear bar, I suspect we'll get at least a small second leg up. I think that's even the case. Even if we go below bar 16, I suspect probably buyers below in a second leg up. Now, is any reversal above 16, is that a major or minor reversal? It's probably going to be minor, which means we'll probably rally for 5 or 10 bars and then have to test back down to this price level. So that's why I'm not convinced that we're going to go all the way up here. What I think is going to happen is something like this. Maybe we rally for 1 times, 1.5, maybe 2 times the range of bar 16, go sideways, and then try and test back lower. Look how much selling we've had on the 15-minute chart. That's a very strong sell-off, and that's probably going to lead to a lot of sideways trading. So look right here. Here's the high, here's the low, there's the midpoint of the day's range. I'm going to go ahead and mark that. I think it's reasonable swing buy above 16, knowing that it's a minor reversal. Obviously, this midpoint of the day is assuming that we don't go lower. I will adjust it if we do. The reason I'm bringing up the midpoint of the day is, 1, it'll be close to the moving average, and then 2, it's about 2 times the range of this signal bar. So no surprise, if you buy above this bar, stop below, and go for 2 times the range of the bar, twice your risk, it takes you exactly to the midpoint of the day. Low one short 17, but probably buyers not far below. Euro versus the dollar, getting strong follow-through selling. First target is the December low right here. Next target, maybe the low of November 14th and then the low of November 10th. But obviously, a really big problem for the bulls. Measure move down from the top of the channel to the bottom, possibly down here. At the moment, this is a strong enough breakout. I suspect we'll get a second leg down. So I'll be very interested to see what kind of entry bar will today be. Will today close on its low or be disappointing? But certainly not looking good for a lot of the bulls. And part of this is because of this open gap up here. So the gap right here, that's a problem. This is, you can see the bears break out, pull back, sell. Some of the bulls who bought above 16 disappointed by 17, and they're getting out break even on 18. But still, I think we're probably going to go more sideways. So you can see here's the gap. The reason it's a negative gap is if we go to a line chart. If we pull up a line chart here, you can see it never closed. Here's the close. Here's a close here. Here's a close right here. This gap is clearly open. We're testing a breakout point from over here. Line charts, the reason why line charts are helpful is sometimes they can take away if you think about it, support and resistance. Most traders look at closes. Institutions, you listen to the news, they all talk about closes of bars. And that does not mean that, what that means is overall support and resistance is most important. The tail on this bar is not as important as everything around it. The reason why people use candlesticks is they give meaning to the bars. Understanding that we sold off, pulled back, sold off, pulled back, that's all important. If this close is a daily chart, but obviously if we look at a lower time frame, we'll see a lot more information. So 18, kind of an implied second entry buy, but I think it's getting really tough for bears to stay short here. The moving average is dropping quickly. So the longer we go sideways here, the more, this is a 20 bar moving average. And the longer we go sideways right here, the more the moving average is going to get dragged down. One of the problems for the bears that I forgot to mention is this dashed line. That's a 60-minute moving average. And you can look right here. We have a rally. Here's the moving average. And this is the 60-minute, 20 bar exponential moving average of the 60-minute chart. And it's really common for the market to go several points below it. So at the moment, I think we're probably going to bounce. How high do we go? Well, I think we're going to have a lot of trouble getting above the high of the first hour. But I would not be surprised if we end up testing back to the close of the prior hour, which is right here. So this red line, close the prior hour, I think we're going up here. And we still have 30 minutes. So we still have 6 bars to get up here. Why is this red line important? Because that is the 60-minute close. So 60-minute close. Always in traders, I would get out above the prior bar. I get the logic. It's a bad stop entry. And what do you do if 19 is a low 2? The bear bar closing on its low, forming a low 2. But my concern is we're probably going to pull back here. Consecutive sell climaxes on the day. I don't think the bears, I don't know if there's a lot of energy left for the bears. Consecutive sell climaxes, trading range. Sell climaxes here, trading range. This is possible, but not as climactic as today. Lots of sell climaxes, sideways, sort of similar to today. We sold off, big bear bar sideways, another big bear bar, second leg down, and then we got a minor reversal up. But what do you notice about all these charts? Big sell-off, minor reversal, and then trading range. Sell-offs, minor reversals, and then trading ranges. Same thing here. Sell-off, minor reversal, trading range. What traders want to see, and what I'm interested in seeing, I want to see bulls make money above bars. I've got an example of this. Bear trend. Bulls making money above bars, converting the market into a trading range. So once you see bulls make money above bars, traders start looking to buy new lows. Different example, but here, bulls making money above bars in a strong bear trend. Strong bear trend ever since here. Bulls could not make money above this bar here, but they finally made money above this bar. How do I define bulls making money above a bar? I use it a little more simple than other traders. I don't really look at ATR, but so this is July 27th of 23. And let's pull up that chart for just a second. So here it is. And what I like to do, I pay attention to the range of the bar. So if I'm a bull and I buy above this bar and put a stop below, that's my risk. So my stop, I buy above, stop below, and price went 1 times the range. Now, if price can go 1 times the range of a relatively decent sized bar, and there's been prior buying pressure, that's going to increase the probability that we're going to get back up there. And if we go to the Globex chart, we'll see it. I'd have to go to the next day, but you can see it right here. Bulls made money, it formed a trading range, and this is the Globex session. We sold off, so here's technically the start of the next day, and here's the overnight hours, and sometime around 10 or 11 o'clock Central Time, we rallied back up to these highs up here. But I would challenge everybody to build charts. It's a really great way to just kind of really think about things. Getting close to the 60-minute close. It's also the open of the current 60-minute hour. Again, I think the first target is the high of 15, and then the 60-minute close, which is basically this price level up here, and then possibly the midpoint of the day. So the bulls have a chance here, but they need to do something with it. I am long. I bought during 15, and I now have a stop below the 16 low. And I'll take half off at the close of this, 2 ticks below the 60-minute close. Looks like bears are giving up here. Bulls are buying. Again, I am not expecting a strong major reversal. Sure, if we start to get strong bull bars, I'll change my mind, but I'm expecting this consecutive sell climaxes, sideways trading. So looking good for the bulls. So let's see how this bar closes. We may go sideways here instead of higher to the moving average. But we're so close to the moving average, I think we're probably going to get drawn up to it. If I'm a bear, I have a lot of trouble convincing myself to sell here. Now, what about selling out of longs? I have no issue selling out of longs or taking partial profits here. Okay, I just got filled on part of my position. And I have an arbitrary target at the moving average. I've been testing out some of NinjaTrader with TradeStation. And I have to say, NinjaTrader, it takes a little bit of getting used to. I'm still trading with TradeStation, and I'm placing occasional orders with NinjaTrader as well. I like NinjaTrader. It's a pretty simple platform. I get why people use it. One thing, I know TradeStation can do it, but TradeStation has the ability, I believe, to use ChartTrader. I think they turned it off on 9.5, and you got to use the new platform. And I'm getting more used to using ChartTrader with Ninja. It's pretty convenient. Now you can just, there's the little price. You can just hit buy at the market and just drag your orders around. That makes it relatively simple. But I have to say, I'm so used to the matrix on TradeStation or the price ladder, as TradeStation calls it a matrix, but most brokers and people call it a price ladder. I just move my orders here. Part of the reason why I use a price ladder, I've mentioned I have a chart over here and then the price ladder over here, is I really don't like orders on my screen. I used to. So when I'm trading, I normally just have the continuous contract and then the matrix set to whatever instrument I'm trading. And the reason for that is, to me, I find that when I have orders showing up on the chart that I'm charting, I get hyper focused on the orders, and it distracts me from what the price action is doing. So when I'm using NinjaTrader, I'll have the orders on the chart, but I'm not really watching that chart from a charting perspective. I'm watching that chart from a management perspective. And that's what I typically do with TradeStation. When I'm trading Forex, I'm charting with Forex. And I'm placing orders. I might be using a chart with something like a window in order to place trades, but I'm always charting with TradeStation. Strong enough bull bar, probably going to get at least a small second leg up. So again, I'm a little bit hesitant to be all that eager to sell this. It's a fairly strong reversal bar, and it increases the probability that we're going to get at least a small second leg up. So I'd rather be long than flat. I'm still holding long a partial position, and I've got a target at 54 even, basically right there. And if the market doesn't race up rather quickly, I'll be pretty quick to exit. This is a situation, though, where I would put a stop at break even, or just put it below this bar, which in this case is basically break even. I'm actually wrong. Break even's right here. But in any regard, if I was long, well, I am long, but if I was going to buy, I'd probably just put a stop a little bit below the bull bar. Now my concern, do I think this will be a buy the close market? Probably not. I think more likely we're going to go more sideways here. Again, I think we're going to have to test back down to this price level later on in the day. Unless the bulls can get an exceptionally strong breakout above the moving average, I think this will be a minor reversal. This could be the low of the day, and therefore I'm certainly not eager to be selling. The bears, they had their selling. They had several chances to sell, and now I think they've lost control, at least for the next maybe hour to 2 hours. Looking good for the bulls. Consecutive bull bars, 2021. Probably going to go at least a little bit higher. Someone said, what about trying to find the low 2 around this area? They mentioned this around bar 21. Maybe. Well, I say that. I think this is too strong for a low 2. You have a consecutive bull bars and it's probably going to lead to a second leg up. Think about it from this perspective. This is what you have to realize about markets. This is 2 legs up on a 5-minute chart. It's implied. This rally to 22 is also at 15 is a rally on a 15-minute chart. I just went flat. In part, I'm getting distracted and I wanted to go ahead. I think this is going to be a minor reversal. So I wanted to go and lock in what I made. And that's also part of a scalper's personality. I'll talk about this chart in a second. But for me, I like scalping. I like getting in and getting out. And the benefit to that is if I trade correctly, most of the trades are winners. The drawdown to that is I tend to not hold trades as long as I could. So here, yes, technically it's by the close, but again, we were below the moving average for 22 bars, assuming 22 touches the moving average. We're below the moving average for 22 bars, and that makes me hesitant to really want to buy up here. Again, look at this. It's 18, 53, 54, 55, 56. So in other words, we're 4 minutes into the rally of this bar, or the formation of bar 22. Why is 22 not racing up to the up? Why is it not racing to the upside? It is a bull bar, but it's a warning that the momentum is slowing down. And the momentum's slowing down because we're getting near resistance. So back to the 15-minute chart. This rally on a 15-minute chart is a strong bull bar. And I suspect there's buyers below. So part of my concern here, why not sell and scale into shorts or look for a low too, is I think the reality is if you're a bull and you're just stagger limit orders, you're probably going to get a second leg up. And what are the chances that we get all the way up here? I think the bulls have their work cut out for them if they're going to do that. I do not think they're going to do it on this first rally. Maybe if we can get a strong breakout, go sideways above the moving average for several bars, then we could get a second leg up. But certainly good selling or good buying. And because of that, I am not willing to sell down here. We had a sell climax on 10, second leg down 15. It's really common for sell climaxes to get second legs. See if I can find an example or two. Well, actually, give me about 2 or 3 minutes and then I'll find an example. I would take partial profits up here. We're right at the moving average and we're probably going to go sideways. You can see profit taking around the moving average, but I suspect buyers probably not far below. This is in part why I got out of longs. I suspected we were probably going to pull back, trying to form a low one, but probably buyers below, scaling in lower. This is a big enough bar that we may get a small second leg down. You can see markets deciding on the close of the 60-minute hour. Here's the open. So if we close above the red line, it'll be a bull bar on the hour. If we close below it, it'd be a bear bar. We're right at the 60-minute moving average, and I suspect we'll probably bounce, but we may get a small second leg. Let me back up. We'll probably get, I suspect that we're going to get a second leg up, but the pullback could be deeper than what traders want. Possible high one buy on 24 and sellers above. Now the sellers above, it's probably minor. I'm not willing to sell above 24. I say sellers above because 23 is big enough that 24 might be a pullback in 25, leading to a small second leg after 23. That second leg down would create a second entry buy. I think we're still going up here, even if we have to pull back for a couple of bars and a couple of legs first. I was long, and I ended up getting out. I bought, it was long down here, scaled in 2 points lower, and I debated. I had a target at 52 or 50, pretty much the close of this bar. I think 1 point below the close. So 52 even. I had a target there. However, when 24 formed a doji, my concern is was sellers above in a second leg, and ended up just getting out for basically break even on my first entry with a profit on my second. Whenever, again, I like to scalp positions and take profits rather quickly. And whenever I don't like the way something's appearing, I normally just get out. That's typically my default. I can always re-enter a trade. And that's something I tell myself each and every, I try to remind myself that every minute of every day. I can re-enter at any time. And because of that, if you can re-enter at any given moment, that's the one benefit to scalping. Give me 1 second here. Midpoint of the day is within reach, and looks like we're there. So we have a bull bar here. 1, 2, and 3. Possible wedge, 1, 2, and 3. A little bit of a surprise on 25. May get at least a small second leg up. But we're right at the moving average, and well, I think the odds are 25 is strong enough for a second leg. I'd almost rather wait and see more closes above the moving average. So I'm a little bit hesitant to want to buy up here. I thought the odds were high at 21 and 22. This rally would get a second leg up and then have the second leg on 25. But we're getting closer and closer to the buy zone. We had a sell climax on bar 7. It's possible that we have to get up there. At the moment, I'm flat and waiting for more information. Someone asked, don't you have to not overthink it and take the first EMA gap bar short? You can take the first EMA gap bar short, but the challenge is it's consecutive sell climaxes, so there's a greater risk of sideways and an upside breakout. I do think if you sell the EMA, it'll pull back. What I'm not sure of is how far it pulls back. I still think there's buyers below scaling in lower. So that's why I'm not interested in selling here. Plus, we're getting a lot of strong bull bars. And that makes me, if I go to a 30-minute chart, here's a 30-minute chart, consecutive bull bars, probably sellers above, but the sellers could be fairly far above. So I'd rather wait and see more selling pressure. Big bull bar, 25, possible exhaustion, and then bad follow through 26. So again, a lot of the bulls aren't eager to be selling up here. Tested the breakout point here. Bears making money. Probably exhaustion. Several ways to draw the wedge. 1, 2, and 3, or 1, 2, and 3, right at the midpoint of the day, the high of bar 10. All of these reasons are, all of those are areas of resistance. but I'd rather wait and see. As far as selling here, I thought if anything, the sell is the close of 25 or on the close of 26. I'd rather wait and see what kind of follow through selling we get, but I'm not willing to buy up here because I think we're in a trading range. This is just too much selling for the bulls to get a strong reversal up on the first go. It'd be better, I think it'd be better for the bulls if they allow a sell-off that has several breaks. In other words, we rallied up for 5 or 10 bars, maybe a little less. I think it'd be better for the bulls if the bears get a sell-off that's not too strong, lasting, bull bar 26, couple of legs up, 27, 28, or bear bar 27, couple of legs up, 28, 29, another leg down, couple of legs up, another leg down, forming some sort of higher low. But why not buy a 50% pullback of the rally from 16 to 25 or 26? That's really not ideal. You can, but the problem is that's assuming that we're going to get a higher low major trend reversal when we don't have to. This could be a bear flag, and we could sell off all the way back to the close of 15. Remember what I said about 15? I said that 15 is the low close of the day, and it may have to get tested. Why would it have to get tested? Because if you sold the close of 15 here at 40.5, look right here on 17 and 18, 40.5, 41.25, 1.25. The market came within 3 ticks of the low close. Some traders might put a stop, a measured move of this bar. So they sell here, they put a stop somewhere up here, and they sell more higher. Not a trade I would be thrilled to take, but even if we get up here, we could still go sideways and reverse down here. But if we're going to do that, the bears need more signs of strength. Bulls, just like the bears, made money selling above 24 during 25, and 27 tested the breakout point. Look what's happening here for the bulls at the low of 26. Bulls buy the low of 26 at bulls buy the low of 26 at 52.5, and we tested it. Let me check a 1-minute chart. We actually did not reach it. The low of bar 26 is 52.5, and the high of the current 1 minute is 52.25. So the market needs to go to 52.75 to allow the bulls out who bought the 26 low. Now, why is that important? Can anyone tell me in Discord? Why is it important? Okay, we just went to 52.75. Why is that important? That's important because if you're buying here and scaling in lower with the limit order, if the market doesn't come back to your original entry, you're going to get trapped. Bulls, they want a small pullback rally. I often look at a 15-minute chart to show examples of price action with what's going on. But again, I think most traders should not trade the 1-minute chart. If you cannot consistently trade a 5-minute chart, going down to a smaller time frame is not going to help you. High one buy above 27, but resistance above. So there might be more sellers above 27 than buyers. So you can see high one buy 27, but sellers above. I think we're starting to try and form a top, and I suspect it'll probably pull back. The bears, they really need a decent sell signal bar. Otherwise, traders will probably wait. And even selling below this bar is not really ideal. So even if 29 is a bear bar closing on its low, it's still a low probability sell. You have overlapping bars right here, and that lowers the probability for bears to do anything. I realized I was on mute. Sorry about that. So here we have a low one, and I mentioned probably buyers below, but the low one would probably get retested, which it did here. And then look what happened. We pulled back even further and then eventually tested down to the low close here. And then we rallied all the way back up here. The reason why we did that is there were trapped traders. Bulls bought the low, scaled in lower, got trapped, and this was likely to get tested. And that's also what led to the deep pullback. Trading ranges are always testing breakout points, going above bars, going below bars, and closing gaps. So even right here, why is this here different from this? We had a sell-off here, two-legged pullback, and then a second leg down here. We had a big bear bar, and instead, bears got trapped, and it'll probably lead to a second leg up. Part of the reason that happened is this was a strong enough rally for a second leg up. Doji, 29, but I'm not willing to sell below that. To me, I really need something stronger. The bulls, they've gotten above the moving average. Next thing they need to do is start getting strong closes above the moving average. Because I mentioned that the reversal up from 16 was probably a minor reversal, that will increase the chances that whatever rally we get, we'll get a deep pullback. So I'm not convinced that we're going to go all the way up here. Measure move from the low of 16 to this breakout point, basically the midpoint of the day. Obviously, takes you up to the high of the day. It's possible that's a breakout point. Any one of these could lead to a breakout, a measuring gap, and measure move up. But I suspect more likely we're probably going to begin to go sideways fairly soon. The bigger this rally is, the more likely we've seen the high of the day. Someone asked, what choice do I make? What RTH choice do you make for NinjaTrader? Let me see what I have it turned on. Right now, I think I have the Globex data turned on for NinjaTrader. But again, I'm charting with TradeStation. So I'm using the NinjaTrader chart whenever I'm placing a trade, just to simply place the trade. I'm not really paying attention that much to the prices. But if you go to NinjaTrader and click on Data Series, scroll down to Trading Hours, you can find CME US Index Futures RTH, and that should allow you to change it to the regular trading hours. Traders are buying because we're breaking above the moving average. We're starting to hold above the moving average, and the bears are not getting good sell signal bars. We may have to get to the 7 close. That is a logical target for the market to reach. Part of the reason why that target is important, I'll fix that in a second. Part of the reason it's important is we had a sell climax here. And because we had a sell climax on 7, it was reasonable to buy the 7 close, even though the odds were we were going to get a second leg down. Those traders got trapped. A lot of those, you can see what happened here on 9. A lot of the bears who sold 7, who bought 7, disappointed on 8. They used 9 to get out break even. But that'll probably be a magnet as well. No sign of a top yet. So bulls are still better off. Bears are better off waiting. Consecutive bull bars, 30 and 31. But let me zoom in. Look where you are. You're getting right at the close of the bar 7. Someone asked, they said they're struggling with stop placement. Can you please explain when you use a tight or a wide stop? Yeah, give me 3 or 4 minutes, and that will be the next question I'll talk about. Strong buying. So we may end up getting all the way up here. But obviously, at the moment, there is no reason to sell. The bears, they tried to stop the selling here. But I think overall, the momentum to the upside was too strong. I do think there's sellers probably not far above. You can see measured move up from the open of 20, close of 22, takes you up here. So why is this happening? It's happening because of these reasons we mentioned with sell climax days. So let's go to gap down and sell climax. Whenever you get a sell climax, this is what normally happens here. This is strong enough selling with no trend line breaks, strong enough selling that the first reversal up was likely to fail. Today, the issue here, sell climax, pause, second leg down. So this is a double bottom 15 and 10. Even though it doesn't act like it, it's a lower low major trend reversal. My concern, though, is the channel down is tight enough that this could just be evolving into a trading range. Someone asked a question about stop entries. When do you use a tight stop versus a wide stop? And you use a tight stop versus a wide stop depending on what you think the market's going to do. So a situation like this, would I use a tight or a wide stop? Well, what's a wide stop? Let's say a wide stop is the 24 low. Does it make any sense to put a stop below 24? Who can answer that question? Yes or no? Does it make sense to put a stop? If I'm long, I'm going to buy, let's say I bought the close of the prior bar. Does it make sense to put a stop down here at the 24 low? Yes, no. No. Okay, so Joey, why? The people that are saying no, who can tell me why? In a short answer. Trader's equation. Yeah, Rod, I like your answer. So overall, I agree with that. The stop down here is an arbitrary stop. It doesn't matter. In theory, you put it below a major swing point, 24, 27, but it's arbitrary. Nobody's going to sell. No one's going to buy here or be long up here and wait for the market to stop them out. Their stop is down here as just a deciding point. I used to hear Al, you'll hear Al in the room say this pretty regularly, but he'd make a comment where someone would say, Al, where's your stop? And he would just say, I was long, and typically how I trade, he says he'll buy, and he looks at his price ladder, his order sends order, puts his stop somewhere down here, so he just drags it lower. And what he is doing with that mentality, by using the wide stop, he's going to exit long before the wide stop gets hit. So the question is, with wide versus tight stops, it gets down to the trader's equation. I'm going to pull it up. I'm going to pull up a spreadsheet. Still always in long, still buy the close, can buy for any reason. The point is, I think a lot of traders are better off using tighter stops. And the reason is, if you're long, it's kind of like this down here. No one's going to sell and put a stop all the way up here because they know that the risk reward is terrible. They sell, their target is somewhere down here. Everybody knows that the market is not going to go that far down. It's not going to go all the way down here. It could, but there's probably, what's the percentage? 20% chance it does that, 30% chance it does that without pulling back. And because of that, a lot of traders use a tighter stop. They'll be short. Maybe they'll put a stop above trend bars. Maybe they'll put a stop above a swing point. When you get a bull bar, a lot of traders exit. Here, they'll probably do the same thing. No one's going to have a stop down here. They're probably going to get out below a bear bar, a couple of points below any bar, and then look to re-enter. And the reason is, if this is not a bull trend, it's a trading range. In a trading range, you want to buy in the lower third. So when do you use a wide stop? In general, there's two instances. Here's an instance where you can use a wide stop. So traders, they look at this and they say, okay, we have a wedge bottom, we rallied here, consecutive bull bars, and they see this getting strong. You could, in theory, say if you're going to trade a higher time frame, like a 60-minute chart and hold overnight, you could put the stop down here. But even with them, even with that, what do traders do? Some traders, are they going to get out here? Some traders might. But they know the first reversal down, probably going to fail and go sideways. But overall, most traders, I would use a tighter stop. So what's tight? If you're long, maybe you put a stop, a measured move down on the bar, taking a chance and just stay long until you get stopped out. We've had so many bull bars up, I suspect we're going to pull back fairly soon. And I'm really not thrilled about buying up here. There's lots of reasons for this market to pull back for at least a couple of legs. Measured move, open to close. So think about the math. This is a 1-to-1 risk reward. So this is the same thing as a wide. This is a wide stop. And if you use a wide stop, you have to be at least 60% profitable. However, if you really dive into the math, 60% at a 1-to-1 risk reward is not a profitable trader's equation. Sure, it's theoretically profitable, but I doubt it's actually profitable, and here's why. This, at face value, assumes that you pay zero commission, you have zero expenses, and you have zero slippage. In other words, it's suboptimal. It's minimum wage, as Al would talk about. It's the same logic as being 40% going for twice your risk. It's not all that ideal. Taking a quick sip of some coffee. And again, I think it's okay to, if you get a bear bar closing on its low, or price pulls back, maybe an average bar range, I think it's okay to get out. So if the market falls 2-ish, 3 points below the prior bar, I think there's nothing wrong with getting out. Back to the spreadsheet. When you have a bad risk reward, you really need to be closer to 70% profitable when you have a 1-to-1 risk reward. Let's just say 60 is acceptable. The issue is this. Most traders, when they're long, they'll put a stop down here. They have the right idea. They'll buy, they'll be long, they'll have a stop, somewhere down here. They have a logical idea, a reasonable premise to take the trade. But what they end up doing is they will naturally never get out. The other problem is this. If you're long and you go for twice your risk, if there's not a 60% chance that it's going to go twice your risk, then you might find yourself with a trader's equation that's actually less than profitable. You see what's happening here? Why is this happening? Because you have a lot of traders exiting. It's the same logic of what I'm talking about. The first reversal down is probably going to fail. But look at this. Do you really want to put a stop here? If you do, the math isn't good. Anyways, to finish this conversation, you do have bulls buying and scaling in. Now, what if you use a wide stop here and you're willing to buy and scale in lower and manage the trade? Well, probabilities change. So overall, if there's one thing I could say about wide stops are very subjective. And if you're not careful, a lot of traders lose with wide stops because they can't get out fast enough. They don't know where to get out. So they sell. They have a good idea. They sell here, stop up here, and they scale in. but they don't know to get out down here, and then they end up just holding. That's why a lot of traders, I would trade always in. And I would focus more on this down here. You're going to have an easier time becoming profitable. Try to get 45% profitability and go for twice your risk. And you're going to find that this number will actually be better than this number, because this number really requires something in this category, 75% profitable. And it's different for everybody. But the overall point is, when you have a wide stop, you do not let the wide stop get hit. You're manually exiting. And that's what I do all the time. I'm long, I'll just move the stop somewhere down here. And I have a method or a plan as far as when to get out. So pretty decent trend line break here. And that's going to lead to a high one buy. Are there more buyers or sellers above? There's obviously buyers below, but there might be more sellers above. I'm not all that eager to be buying above a big bear bar, even if it's a bull bar. I'm really not eager to buy above it in a fairly strong sell-off. Not eager to buy above it in a fairly strong sell-off. So always in long, yes. Testing the moving average here, yes. But I have to say, if the bulls were all that bullish, why did they allow a pullback this steep? Bulls obviously trying to get an upside breakout. I think the fight is over getting up here. So the next target is the top of the channel, the 8 high. And then the target after that is going to be the 3 low. And then maybe the bar 6 breakout point. Outside up bar, but outside bars are generally trading range bars. And that will lower the probability of traders buying above it. An outside bar is an expanding triangle. It's breaking below and breaking above. Here, this outside bar, think about distance. This bar, the prior bar, went more below bar 34 than it did above 34. So it's a bearish outside bar. It reversed up sharply, and that's good for the bulls, but there are trapped bears who sold the breakout, and because of that, those bears may scale in higher. I don't think the bull should not have allowed 35 to sell off as much as it did. Now, that doesn't mean we're going to evolve into a bear trend, but what it does mean is I think there's bears selling and scaling in higher. This does not look like a strong rally. Strong rallies look like this. This is a strong rally. Bull breakout, little overlap with the bars, and continuing bull bars. This is that same chart, just zoomed in. You can see very tight bull channel on a 1-minute chart, which makes up this 5-minute chart here. So that makes me think we're probably going to stall for a bar or two. So ask yourself, what's the probability of buying here, buying the close, stop below this bar, target up here? I do not think it's 60%, and that makes me think there's more sellers above than buyers. Whenever you're thinking about stop entries, it's important to weigh time. We're basically 4 minutes, almost 3 minutes into the formation of bar 36, and we still have yet to go above bar 37. That's a reminder that as strong as this rally is, there's issues with the rally. The bulls, they're hopeful they can get an upside breakout. Now, one of the defaults that I have whenever I think a channel is tight, I'm generally resistant to fading the rally. In other words, I'd rather wait for a stop entry sell if I'm going to take a sell. Obviously, tight bull channel, but issues with the channel. Because 35 went so many points below 34, I think there's it's reasonable to assume that there might be sellers above 35, and we need 36 to pull back a little bit more than what traders want. We reach that target. Here's the next target. But obviously, a lot of consecutive bull bars, and that's good for the bulls. But you can see on the rally, bears, they get out above 16. No reason to sell here. Not a good sell below 26. Bad sell below 29. And then that led to an upside breakout. What are the chances we get a rally to here? The low of 18 to the close of 22. We might get that. It will be interesting to see. Do the bulls have enough energy to get up here? Down here, I did not think we would get up here. Now, it's obviously, there's a greater risk that we're going to get up to the open of the day. I'm still suspicious that we're going to get there, but obviously every bull bar that gets added slightly increases the probability that we go a little bit higher. Someone asked, do I use BWAP? I do not. You can see as soon as that bar closed, traders bought it. That's good for the bulls. So you have some bears who might be getting trapped here. They sold above 35 or sold above 34, and they might be getting squeezed out. But if you're long, this is one of those, it's a swing trade. You know, if you're long, if you got out a couple of points here, maybe you buy again above 35, and then you wait and you exit below a bear bar. We're getting a bull break out of this bull channel. And getting a bigger bull bar on 37. So again, any one of these could reverse down. So we had a bull micro channel, first reversal down, failed, and it's reversing up. So let's see what happens here. Getting close to the 6 low, where a lot of limit order bulls got trapped. So I suspect that will lead to some profit taking. But again, this is too strong for bears to be selling. You can see strong reversal up on the 60-minute chart. Bull trend, trend line break. This rally could lead to a high 1 on a higher time frame, like a 240-minute chart, or maybe even a daily chart. We could rally, form a high 1, and then get a deeper pullback. Bulls trying hard to get to the open of the day. You see why we're pulling back here on 37? Because it's a big bar and it's getting more and more climactic. You buy the close? Some traders will, but getting more and more climactic, and that increases the risk of a pullback. Plus, look where you are. You're getting closer to resistance. But the first reversal down probably will fail. So traders that are buying, they're probably willing to buy more lower. We're so close to the open of the day that we're getting vacuumed up to it. Obviously, very strong rally. Does this surprise me at all? No. Not one bit. Remember what I said about these charts? Sell climax and then reversal. Sell climax, reversal. Now, the one thing I will say about this, what's the chances we get a strong bull trend day? I think those odds are pretty low. This is today's range. Let me look at my other computer. I don't have that workspace open, but today's range is, I'm going to fix this. Let's do that. It's about 36 points. And that range is pretty big. So I doubt we're going to go much above the open. Obviously, strong buying. I think the market's going to have a hard time escaping the high of bar one, open of the day, open of the week. That makes me think we're probably going to have to get up here. This rally is just too strong. And there's too much momentum behind it to make me think that the bears are going to overwhelm the bulls up here. It's possible, but it's kind of like this right here on the weekly chart. The market's going to have to go more sideways, and the first reversal down probably will fail, which increases the risk that we're going to go, that whatever sell-off we get will fail, and we'll probably get up here. Someone said they have a hard time counting legs when the channel is this tight. And the reason for that's pretty simple. The reason you have a hard time counting legs when the market is in this tight of a channel is all of these pullbacks on these tails, they're implied legs on smaller time frames. But since smaller time frames make up larger time frames, what that means is they keep getting reset. So here, this is basically a wedge. 1, pause, 2, pause, 3, or 1, 2, 3, doesn't really matter. We tried to form a leg in a trading range. We tested, in other words, from here to here. It's a bull channel. We have a trend line break, rally, bull channel. We tried to test basically 50% of the channel, and instead of forming a trading range, we broke above the channel. And then because of that, we'll probably get a second leg up. But tight bull channels have a higher probability of getting reset. Doji, inside bar, possible final flag. But here's the issue. Do you really want to sell this tight of a channel? 15-minute chart. What about a 10-minute chart? 45-minute chart. Lots of big bull bars. That's the point I'm making. So yes, we could pull back for a couple of legs, but even if we do, so far, the bears have made money technically below this bull bar. But if you're a bear, do you really want to sell below 34? Most traders do not. And because of that, this makes me think that we're probably going to go more sideways to up. It's possible that the bears get trapped. But more likely, buyers below scaling in lower. The risk is consecutive sell climaxes. Bears trying to break to the downside. But I suspect buyers below 39 and buyers below 40. Bull bar, but a high one buy above. So there might be more sellers above 40 than buyers. But even if there are more sellers above, I suspect that the sellers are temporary. So some bears will sell above, betting on a deeper pullback. But the reality is bulls that buy above 40 and scale in lower, they're probably going to make money. It's kind of like that crude oil example here. It's a low one short. There's probably buyers below, but even if we get a deep pullback, I suspect we'll retest it. Do the bears exit if 41's a bear bar closing on its low? They might. Other traders might wait for one more bar. More likely, 40 and 41 are minor reversals. And the market will evolve into a trading range. So rally, sell off for a couple of legs, and go sideways. 4-bar bear micro channel, but overlap with all 4 of the bars, and 41 failed to close below 40. Increases the probability that we're going to go more sideways here. But probably sellers above 41. But I suspect the sellers are scalping. What about selling above 41? I don't know. I'm not going to do that. Too much risk that we get. I think there's too much risk we get up to the open of the day, open of the week. 5-bar bear micro channel, but a lot of overlapping bars. Inside bar 42. Increase the risk of buyers below in a pullback. I suspect we're probably going to go mostly sideways here. We'll probably retest up to the highs. And the market's deciding if we're going to get up to the high of the day. Looks like there's more buyers below than sellers, but certainly disappointing for bulls. Are we always in short? I think the bears need one more bar. The bears are doing a good job disappointing the bulls, but look at this. When you look at 43, do you really want to sell the close of it? And therefore, I think there's more likely buyers below scaling in lower. But certainly disappointing for the bulls. This is why I mentioned if you're buying up here, most of these traders buying here are using a wide stop and scaling in lower. What's wide? Somewhere down here. And the reality is, the way they're trading is they're going to exit long before that stop gets hit. So not what you want to see if you're a bear. That's why I was saying the bears need to do more here. I still think at least 50-50 chance we get up to the open of the day, open of the week up here. Wedge, 1, 2, and 3. It doesn't look like a wedge, but it's basically a wedge. It's a wedge on a smaller time frame. Pull up the daily chart. Crude oil sold off to the apex of a triangle here. Strong enough sell-off, probably going to have buyers below. But what I meant to say, since we're in the apex, the odds are it's going to bounce, but strong enough sell-off that there's probably sellers above, and we're going to go more sideways here. 60-minute chart. Fairly strong reversal, but tight bear channel. So we'll probably get at least a small second leg up, but the bulls, they really need to do more. 240-minute chart, big bull bar. Enough of a surprise. I think we'll bounce for a second leg, maybe test these breakout points here, maybe the high of this bar here. 5-minute chart of the E-mini, testing near the high close right here. But I think 50-50 chance we probably go up here. depending on what kind of breakout, depending on how this bar looks. Breakout, depending on how this bar looks. You can see hesitation at the high close, bar 38. Bulls by the close, 68.5. The high of this bar, 68.25. So they've come within one tick. I think if you're long, it's okay to take part off right here, just in case we do not reach the open of the day. But like I said, I think there's at least 50-50 chance we get up here. Probably going to go above the 38 high. Again, I think this is all about the opening tick of the day. So here's an example. I can't remember where the opening tick being the high or low of the day slides are, but I know that if I search open, there's not that many subjects that start with open. So if I go to this spreadsheet, I can find it right here. Open was the high of the day. It's part 11. And that's just because I've spent enough time looking at these slides. So pretty interesting that we sold off a good bit and we're coming back to it. The difference here, there's a couple of things that's important that increase the probability of this sell-off being a leg in a trading range. Part of those reasons is the higher time frames. We had bears, we had a big bear bar, strong rally here, and a lot of those bears got trapped. And because of that, it increased the probability that the first reversal down would fail. Trying to get a bear bar closing on its low. It'd be a failed breakout of the 38 high. But again, we're so close to the open of the day that I suspect we'll probably get it there. Tough to hold long if 46 closes on its low, though. 46 pulling back may just be a retest of 50%, this low to this high. Here's 50%. It's also trapped bears. Bears sell, scale in, trying to get out, break even. Probably buyers below, and we'll have to get to the high of bar 1. I think it's also okay for bulls to exit below 76 or 46. Big bar, so big risk for the bears. So it's not a great sell for the bears either, especially if 46 has a decent tail below the bar. 46, big enough a bar, bears want a second leg down. Sell off, pull back 46, bears want a second leg 47. Even if we get consecutive bear bars, I still think probably buyers below and more sideways. Now the buyers below could be all the way down here. We don't have to get to the open of the day, but it's an obvious magnet, and therefore there's added risk that we get up there. You have more bulls exiting here. Good for the bears, but I think the bears probably need maybe one more bar. Tail below. lowers the probability of selling the close of 47. Again, I think 47 is probably a minor reversal. And there's probably buyers below 46, 47, strong enough for a second leg down. So that may lead to sideways trading for a couple of bars. With consecutive bear bars, 46, 47, you will have bulls, some bulls exiting below 47, and then looking to buy again above a bull bar. Bears need to do more to make it clearly always in short. But bears are certainly doing a good job. And every bar that gets added increases the probability that it's becoming always in short. Strong reversal. Probably going to get at least a small second leg down. So I don't know if we're going to get back to the open of the week now. This is pretty strong. It makes me think that we're going to go a little bit lower, maybe back to the midpoint of the day. It's almost 20 gap bar buy, but with those 3 consecutive bear bars, I suspect we'll probably get at least a small second leg down. Bulls want a 2-legged pullback, leg 1, pullback, leg 2. But I'm a little bit suspect of buying above 49 with those 3 consecutive bear bars. Do bulls buy above it? Some bulls might, but with 3 consecutive bear bars, I think we may go more sideways than straight up. I think most traders should wait here. You can buy above 49, but I think we may get a lower high, and we may have to retest the 48 close. So it's not really a great buy. This is why I was not a fan of buying above 49. Too many bars down. But obviously, 49 is disappointing for the bears. And there might be buyers below 50. Full follow through, but a tail above. Low 1 short for the bears, selling below below 50. Probably buyers not far below it. I'd be more willing to buy if we didn't have 46, 47, and 48. That's a surprise, and surprises usually get at least a brief second leg down. $60-minute chart. It's possible we have to test the gap here, but that's 53.75, and that's all the way down here. So I don't know if we're going to get there. As far as buying below 50, I don't know. I'm a little bit hesitant with those 3 big bear bars. You can see disappointed bears down here who are short, scaled in higher, getting out break even. What about buying above 51? Right now, it's a doji, and it's overlapping the past several bars, and that will increase the risk that there might be more sellers above, and that we have to get closer to the 48 close. Bull bar, so good for the bulls, but a small body on 51. That will lower the probability of buying above it. And the bulls, obviously the bulls want a reversal and test to the open of the day, open of the week. Again, I think the problem for the bulls is these three big bear bars. Bulls want a reversal and a test of the 45 close. Bears want a low 2 with 52 and a bear flag from the sell-off to 48. Bulls, they're trying to get an endless pullback and a reversal and an upside breakout. The bears, they're trying to create a bear flag. And the market's deciding which one will win. The bears are hopeful that they can get a strong downside breakout below the 48 close. You can see some bears selling the close, scaling in, trying to get out break even on the entire trade. So traders will pay attention to the retest of the 48 close if we have a retest. Bulls trying to get a reversal, trapping the bears who sold the close of 48. What about buying above 54? It's still buying in the middle of a tight trading range. So just because it's a bull bar closing on its high does not make it a high probability buy. The market is getting very neutral. The bears, they're still trying to get down to the 48 close. Bears doing a good job preventing bar 54 from triggering. It's basically a wedge. We rallied on 50, pulled back 51, rallied on 52, pulled back 54, rallied on 54. So it's basically a wedge, and the bears are trying to get a reversal down. But lots of bull bars, and that damages the likelihood of this being a bear flag. The important thing to realize right here is that the market would not be doing this if one side had significant probability. So if one side had a 60% chance of continued prices, we would not be doing this. And you know, the simple fact that we're going sideways in a tight trading range, you know the probabilities are close to 50-50. If I had to guess, I still think we're going to try and test the 48 close. So I think probability still slightly favors the bears. The key word is slightly. It's not 60%. Inside bar, but a tail below the bar. It's basically a low 3, although it doesn't look like it. Bears still trying to get the downside breakout, but they need to do more here. The bulls obviously want the opposite and a measured move up. Not a great bar to buy above on 56, so may go more sideways up here. Wedge, but not a great shape. 1, 2, 3. So let's see what 57 looks like. Why did we sell off here? Bulls were disappointed. Bulls that bought up here, disappointed by 46, 47, 48, and they scaled in lower, and they used the bounce to sell out of longs. That doesn't mean we're going to get a reversal down here, but it's a sign and a warning that bulls are disappointed. Inside bar, bear bar, closing on its low. I think it's credible for the bulls to get out below 57 if it triggers. We have a wedge, 1, 2, and 3. The bulls, they want a bull break out of the wedge and a rally to the open of the day. The bears, they want to trigger the sell and get a second leg down from the sell off from 46 to 48. But a weak entry bar for the wedge, 57, probably going to go more sideways. $59, a little bit of a surprise, may get a small second leg up, the top of the trading range, so not a great area to be buying. Broke out above 46 and pulling back a little bit. So trading range, we have the magnet of the open of the day not far above, but probably going to go mostly sideways here. Consecutive bull bars, so close to the magnet, probably going to get there, but we may have to pull back first. There you go. We went above the high of bar 1. How much higher will we go? Well, in part, it depends on how this bar closes. The bigger the tail, if it closes above 1, increases the probability of higher prices. If it closes far below 1, increases the odds that we pull back. Three consecutive bull bars, good for the bulls. Probably going to go at least a little bit higher. Measured move up from the bull breakout of the bull flag, but strong enough breakout, probably a second leg up likely. Yesterday's close. Possible target. Consecutive bull bars. Strong enough rally for at least a small second leg up, but I doubt we're going to go all that far. So we're probably going to be sideways here. This will limit the downside though. So I suspect you will have disappointed bears here. Strong enough reversal that the bears who sold are trapped. So I suspect the first reversal down will probably fail. Strong enough rally, probably buyers below, but forcing traders to buy where the bulls originally got trapped. And that can lead to a deeper pullback than what the bulls want. Bar 72, probably better just to let everything go and wait until tomorrow. Chances are we're going to go more sideways here. And we probably won't go that far up or that far down. 4 consecutive bull bars, open gaps, trapped bears, probably going to go at least a little bit higher. We're right at the top of the range, so I suspect we'll probably pull back fairly soon. This is what I meant by we might pull back fairly soon. So a little bit problematic for the bulls who are buying. Again, I think it's better for most traders to just be flat and wait for tomorrow. Probably buyers below 73, but we may test the breakout point on 70 before buyers come in. The buyers below 73, but we may test the breakout point on 70 before buyers come in. Part of the reason why we bounced here was the trapped bears on 48. When the market's usually sideways around 2:30 Central Time, 12:30 Pacific, usually you get this. I'm not finding what I'm looking for, but typically at the end of the day, when you're going sideways, it's usually better just to be flat. The market's deciding if it's got to get down to the 69 and close. It was reasonable to sell 69, and because it was reasonable, that makes me think we're probably going to try and get down there. Buy the close bulls who bought anywhere up here, holding a losing position with 74 and 75. So it's possible that those bulls give up. More likely, we're going to be sideways here. Really not much left to do with the day. I think it's really easy to get trapped at the end of the day. So it's usually better just to be flat and waiting for the next day. Question, would you ever buy 28 as a scalp because 27 is a failed low too? Yeah, I can see the logic with that. So the question is, would you ever buy bar 28 here as a long scalp because 27 is a failed low too? My only concern with that is, give me just a second here. My only concern with that trade is buying here, betting on a failed low too. I'd rather wait and see the breakout. So it's not a great probability buy, because if you buy above 28, what do you do if 29 is a bear bar closing on its low? And that might entice traders to exit. But I get the logic with taking that trade. For me though, with it being at the moving average, I'd rather wait and see the strong breakout. Interesting day overall. And you can see bar one, there's several reasons. To me, it's more kind of coincidence and interesting that bar one price still happened to go above bar one. Higher time frame context obviously is at play. We just zoom out of this chart. Very strong rally. And it looks like this is pretty much 50% pullback. So it's not quite 50% pullback, maybe from the lows over here, bar 21-ish on the first trading day of February, takes you almost to 50% pullback. Daily chart. We pulled back today after last Thursday and Friday. That's good for the bulls. Let me move this around. There we go. consecutive bull bars last Thursday and Friday, good for the bulls, and we pulled back testing breakout points here and almost here. High one buy, it's an inside bar. Are there more buyers or sellers above today's high? There might temporarily be more sellers above. I do think we're going to test 5,000 and reach it. And I think there's also buyers below here. So I wouldn't be surprised tomorrow if we trigger the buy above today's high, pull back, and then maybe rally and test 5,000. But we'll see. I'm going to adjust the monitors really quick. Bar 1, bear bar. Big enough bar, we'll probably get at least. It's a big enough bar that there's probably sellers above, buyers below. But because of the sell-off, I suspect we're a lot closer to support than resistance. Better to wait for consecutive bars though. And then bar 2, consecutive bear bars, close above the one low rather than at it. Probably going to go more sideways here. I didn't mean to do that. There we go. 3, we have a bull bar. And as I mentioned, because of the open being the high of the bar, and we're probably in the bottom of a trading range, I thought the odds favored a bounce and probably a test above the one high. We triggered the buy above 3 during 4, but it's a weak. 3 is a weak stop entry buy. Increases the probability that we're going to go more sideways. 4, weak entry bar for the bulls on 3. Low one short below the bar, probably buyers below and more sideways. So we may have to get all the way down to Friday's 40 low right here. And then you can see we triggered the low one short on 5 and then bounced. For the bulls, it's a second entry buy, but probably going to go more sideways. And then 6, we triggered the buy above 5 and then reversed down on 6. For the bulls, it's a small triangle. For the bears, you can call it a double top bear flag. Gap down, pull back on 4, pull back on 6. Low probability sell below 6. You can take it for a swing, but probably going to go more sideways than straight down. And then we got a surprise breakout on 7. 7, strong enough bar, probably going to go at least a little bit lower. So probably always in short. However, because it's late in this channel, I suspect the follow through could be bad. Even if we get a bull bar on 8, probably sellers above and a second leg down. 9 consecutive bear bars. And follow through after 7 with a gap, the 3 low, 7 high, 3 low, 8 high, or 6 low and 8 high. Probably going to go more sideways. Probably going to get a second leg down. Therefore, you can take this, you can sell the close, betting on a second leg. My only problem here with selling is how far we are from the moving average. 9, another bear breakout, starting to channel. We had a bear breakout on 7, and then overlapping bars 8 and 9, part of the channel. We may go a little bit lower, but again, I suspect we'll pull back fairly soon. And then 10, we got a big bear bar. So we had a breakout on 7, strong enough for a second leg, and then we went sideways on 8 and 9. And now we have a big bear bar on 10. 10, that's a climactic sell-off. You can see this whole, you can look at this whole thing as a bear channel from either this swing point or this swing point. We sold off, and now we're breaking below a lot of bars. So the market's becoming more and more climactic. Plus, look to the left. We're testing this blue line, which is the equivalent of the 60-minute moving average. It is not 100% accurate. It's an input of 221, which is close enough to the 220, the 20-period moving average on the 60-minute chart. This one is showing 47.01, and here it's showing, let me fix the chart, here it is showing, it's hard to read this, but 46.65, so it's close enough. Probably going to go at least a little bit lower, but a sell climax late in a sell-off that began up here. I suspect we're probably going to enter a trading range fairly soon. Doji, inside bar, possible final flag. if we break below it. And then 12, we're pulling back to the midpoint of the bar, but there's probably sellers in this area. 13, doji, low one short, probably buyers below. And then 14, an inside bar. So you can see what happened with 11 through 14. The market sold off and rallied, sold off, rallied, sold off again, and rallied. So it's a variation of a wedge on a smaller time frame. Low probability sell below 14, and the bears ended up getting the successful second leg down after 14. Bar 15, it's a second leg down after consecutive sell climaxes. We had a sell climax on 7, pause, 8, 9, sell climax 10, pause for 4 bars, sell climax here. Probably going to go more sideways to up for the bears. If you take the sell, which I would not, I think it's getting more and more dangerous. If you do take the sell, it's probably best to exit any shorts above a bull bar at this point. Too much risk, we're going to pull back. Let me check one thing on my other computer. And then we got a bull bar on 16 for the bulls. And by the way, I would never, as you know, and I've said this, I would never keep the scaling like this, where it's this much room and then this much room up here. It gives the illusion that price is going to fail to break lower because it's at the bottom of the screen, and that's not true. I just have it here because we know this is the low of the day. 16 bull bar, certainly reasonable for always in bears to get out above 16. It's an okay swing buy for the bears. It's an okay swing buy for the bulls. Probably minor reversal, but parabolic wedge, 3, 10, and 15. So it's an okay swing. Doji on 17, low one short, probably buyers below and more sideways to up. And then 18, we have a bull bar. For the bulls, second entry buy. Bears who sold the close of 15, more higher, trapped with 17 and 18. And because of that, they may look to exit above any bull bar at this point, such as bar 18. 19 consecutive bull bars. Not yet always in long, but now we have a 4-bar micro channel after a sell to close bar 15. Okay to exit longs and look to sell again higher. Part of the reason I would exit longs here is think about the bears. You had bears selling all through this and even selling on 7. Do you really think they're going to be selling down here? This is very late in sell-off. And the later you get in the sell-off, the more likely you're going to have profit taking and only bulls buying. If you listen to Al, you've heard Al talk about strong bulls, and strong bears and weak bears. The strong bears, they were selling up here, selling above bars, selling as the market's going lower, selling here, and they're using these bars to take profits down here. The strong bulls, they were buying once they thought the market was becoming climactic here, buying at the moving average. The strong bulls are not going to get shaken out of the trade. And because of that, it increases the odds that the market is going to go more sideways here rather than straight down. It increases the odds that the market's going to go sideways to up here. If there's not a lot of eager bears looking to sell, then the only bears that are actually selling here are the weak bulls and the weak bears. The weak bears, they're selling anywhere over here, and they're going to get shaken out rather quickly. And the weak bulls, same thing. They're buying, and they cannot take the pain down, and they're going to end up exiting right around the lows. That's kind of a more, obviously you can better explain it with better logic what's going on, but it's just a simple reminder. The longer and more protracted a move goes, the greater the risk of a reversal. 19, 4 consecutive 4-bar micro channel, and then obviously 20, bears giving up, bulls starting to buy. Probably going to go at least a little bit higher. 20 is a strong enough bar. We'll probably get at least a small second leg up. And then 21 consecutive bull bars, break out 20, follow through 21. In a 6-bar bull micro channel, probably buy the close and buy any pullback. 22, 3 consecutive bull bars in a 7-bar bull microchannel, probably, again, buy and buy lower. You're so close to the moving average in the 9 breakout point that I suspect there's probably profit taking not far above. And that's what happened with 23. 23, enough of a surprise. We'll probably go at least a little bit lower. However, it's a bear bar following a 7-bar bull microchannel, and it makes sense for the bulls to get a second leg up. It's basically a wedge. 1, 2, and 3. Doji 24, probably buyers below, scaling in lower. There might be more sellers above, but the sellers above 24, I suspect they will probably exit rather quickly. I suspect those traders will exit rather quickly. In other words, the bear is selling, they're selling for a scalp, they're not selling for a swing, and because of that, we can break out to the upside in any moment. I need to check one more thing here. 25, surprise bar, strong enough bar that will probably go at least a little bit higher. It's a second leg up from the rally up to 22. For the bulls, what about buying the close? You're buying right at the midpoint, this thicker blue line. And that, because of that, it's not really an ideal area for traders to be buying. So I think it's probably better for traders to look for a pullback or wait for an upside breakout. 27, breakout below 26, but tight bull channel. You can see limit order bears selling above 24, scaling in higher above 23, making money, increases the odds that we're going to go more sideways. And then you can see 28. It's a bull bar, breakout pullback buy above 27. You can call 27 a high 1 buy. Doesn't really matter. We had a low 2 with over here and here. You can also call it a wedge, 1, 2, and 3. What about buying the close of 28? I would not. I'd rather wait and see more follow through. I'd rather wait and see follow through buying above the moving average in a series of bull bars if I'm going to buy high and relatively late in a move. Doji 29, probably buyers below, and then 30, we're going to get bull breakout. You can call it a wedge, 1, 2, 3, bull breakout of a wedge, so make it a second leg up. Follow through 31, but a weak follow through bar, arguably buy the close and probably going a little bit higher, but not all that clear. 32, 6-bar bull micro channel, 3 consecutive bull bars, probably going to go at least a little bit higher. And then 33, another bull bar. Are we always in long? We are always in long, but I suspect we're probably going to get a pullback fairly soon. It's possible that we're going to get all the way up to the 1 low. However, the rally is not all that strong. The bulls have done a good job getting above the moving average, but we still have a lot of overlap, and that increases the odds that we may have to pull back lower. 34, another bull bar in this micro channel, probably buyers below, scaling in lower. And then 35, you can see we broke below several bars and reversed up sharply. Strong 35 is a little bit of a surprise. Therefore, we may get a small second leg up because of the targets above. It's possible that 35 is breaking out of a bull channel. We have a bull rally, pullback. We've been channeling up. It's possible 35 is a bull breakout of that channel and we get some kind of measured move from maybe the 24 low all the way up to here, or the 27 low all the way up here. 36, breakout, follow through, probably by the close going a little bit higher. Same thing with 37, but a tail. 38, a bigger tail with a bigger body, increases the odds we're going to go more sideways. Now, sideways does not mean we're going to reverse. It just means we can get a deep pullback. Doji, 39, lots of bull bars. Okay to exit longs up here, and if you are buying lower, you probably need a wide stop somewhere below the moving average, just in case you get a deeper pullback than what's expected. 40 bear bar, close below 39, bad high 1, so there might be more sellers above. And then 41, 4 bar micro channel, 2 consecutive bear bars. However, tail below 40, tail below 41, probably going to go more sideways. 42, a bull bar, but a bad high 1, probably more sellers above and sideways. I do think we're going to test up to the open of the week. And then 43, we tried to break to the downside and reversed up. Part of the reason we did that, there's a few reasons. One is this right here. It was reasonable to sell the 35 high, and you can see bears sold it, and then they got trapped with 36, 37. So what are those bears going to do on a retest? A lot of those bears are going to buy back shorts. And you have bulls who didn't buy. They were trapped out. So when the market starts to sell off in a week sell-off, traders start buying the breakout points. 43, strong enough reversal up, makes me think we're going to test up to the 38 close and the 39 and the 38 high, and probably the open of the week. 44, bull bar, probably going to go at least a little bit higher. 45, the second leg up. Strong enough surprise, 44, 45, that I think the odds at this point favor a test at the open of the week. However, we have obviously consecutive buy climaxes, strong sell-off in terms of distance down to here. There's probably sellers not far above. Bad signal bar, 43 high, so we may need to retest it. What about buying the close of 45? You can buy the close of 45, but look where you are. The distance from the high of 1 here, this green line, to the close of 45 is not all that big. And if you're buying here, the problem is risk reward. If you put a stop below 45, 1 times your risk is above the green line. Therefore, it's really bad risk reward. And that's why a lot of traders, you can see on 46, there are more sellers on the close of 46. 46, enough of a surprise, probably going to get at least a small second leg down. That's why traders sold the close of 47. Consecutive bear bars, 46, 47, probably buyers below scaling in lower. But because of the consecutive bear bars, we'll probably get another leg down and maybe a test of the 43 low. And then we got 3 consecutive bear bars, 46, 47, 48. It's enough of a sell-off and enough of a surprise that we're probably going to go at least a little bit lower. So as far as selling this, I think it's fairly. Let me back up. As far as selling the close 48, it's a little bit dangerous. You're selling, betting on a second leg down. But what do you notice about the context of all of this? You're selling. You're selling what could be a trap. And because of that, I think it's better to look to sell a pullback. 49, bull bar, closing on its high. Probably going to go more sideways to down and retest the 48 close. But 49 is a warning that there's trapped bears and they may look to buy any pullback. And that's what happened with 41, and that's what happened with 50 and 51. 50, low 1 short, probably buyers below. Bulls bought it during 51. 51, it's a weak stop entry buy above. Therefore, there's probably sellers above. 52, it's a weak low 2. Probably buyers below scaling and lower, but they may not buy until we get closer to the low 1. Some bears sell the low 1, scaling higher. 53, bear bar, but following 4 bull bars, so not really a great place to sell. And then you can see what happened on 54. If he sold below 50 right here, bar 50, your entry price is 3 1/4. And then the low of bar 54 is 3.25. So it's 3 1/4. So it touched the entry price for the bears who sold below 50. 54, reversal up, but overlapping the bars to the left, so not a great buy. 55, inside bar, not a great sell. So obviously breakout mode. We have a bear breakout. Bears want a second leg down. the bulls, they're hopeful that the sell-off to 48 is just a pullback and a two-legged pullback from the rally that began on the low of the day. 56, bull bar, trying to break out to the upside, but pulled back. Trapped bulls who bought anywhere up here, scaling in lower. That's why we're pulling back here. And the bears know that, so the bears are trying to force they're trying to force a second leg down. But the only problem is, this is really the first test of the moving average. And we've only had two bars. We've only had one close below the moving average since bar 27. And therefore, not really all that ideal of an area to be selling. 57, it's a wedge, but a lot of overlapping bars. And instead of getting a bear breakout on 58, we had bad follow through. And that's why 59 reversed up. 59, possible full breakout of a wedge. So traders will think about the idea of a measured move up. 60, follow through, probably going to go at least a little bit higher. And then 61, another breakout. Strong enough rally, second leg up likely. You can see we tested the measured move target, 6.75. The high of this bar, 6.75. And that's the breakout of the bull channel. Bull channel, you can call it a wedge. It's usually, we got a bull breakout of the bull channel. The bull channel should have acted as a bear flag, sell off, pull back, second leg down. Instead, we got an upside breakout. Probably buyers below, scaling in lower. Inside bar 63, possible 2-bar final flag, and then we broke out above the inside bar on 64. But high one, breakout, pullback buy, right at yesterday's close. Really a dangerous area to be buying. Doji, probably going to go more sideways, and then another doji bar. So we have a doji on 62, inside bar 63. We broke above the triangle on 64, pulled back 65, and then 66 we have another inside bar. This does not look like the start of a strong bull trend. It looks like what's going to become a failed breakout of a trading range day. 67, surprise, bear bar, probably going to go at least a little bit lower. 68, follow through. 69, more follow through. More follow through. 3 consecutive bear bars, probably going to go at least a little bit lower. And then you can see 70, we pulled back. What about, was 69 sell to close? You can argue it was, but it's forcing you to sell at the bottom of a trading range, so it's not all that strong of a sell to close area. But if you did take the sell and scaled it higher, you'll probably make money. And now 70, 71 consecutive bull bars. For the bulls, it's a trading range market. Therefore, we could get a really deep pullback before we get the test down. It was reasonable to buy up here. And look what happened. Bulls got trapped on 67 and 68. And because of that, we may get a rally all the way back to these breakout points. 72, 3 consecutive bull bars. Is it buy the close? Well, look what's happened every time traders have bought a breakout. They bought up here, it reversed. They sold here, it reversed. Chances are, even though we got 3 consecutive bull bars and an open gap with 70 and the 72 low, we're probably going to go more sideways here. 73, 4 consecutive bull bars, probably going to go. And you're starting to get overlapping bars late in the day. Not really an ideal area to be buying. And then you can see we pulled back with 74, 75, 76. Why did we bounce on 77? You can see we sold off 74, 75, and then we rallied on 76 here and sold off again. So in essence, we broke a trend line and we're testing support. That's why 77 reversed up as sharp as it did. And then as far as buying up here, you're buying, we're in an area where there's trapped bulls. Bulls bought up here, disappointed. They'll probably look to sell up here. And that's what led to a second leg down with 78. 78, it's an outside bar, probably buyers below, but the buyers may not come in until we go lower. Maybe the test of the 35 low, midpoint of the day, the January 30th high, somewhere down here. And you can see we sold off to the midpoint of the day, to the tick, and reversed up. The midpoint is about 55.25. and you can see 55.5. And then we went sideways into the close. For always in, I think the first always in trade is selling below 6 or selling the close of 7 or the follow through on 8. Bulls, where do the bears get out? I think a lot of bears would get out above 12, but technically it never triggered, so they're still in. And then I think everybody gets out above 16. For the bulls, it's an okay swing buy above 16. It's a Walmart trade. Buy above 16. And I talked about that. I didn't talk about the Walmart trade, but I talked about the logic of buying here. You buy above 16 here. I adjusted the hotkeys. I'm just going to change that. Give me 1 second. It's really causing more issues than it's worth. I was getting issues where when I would type in a chart, the symbols wouldn't work, so like the @ or the dot wouldn't work. So I started trying control, but when I use control, it messes up and doesn't allow me to perform the hotkey like I normally would. So let me see if this works. There we go. So what I mentioned here was it's an okay swing buy, betting on a test of the midpoint in the day and the close of the second hour or open of the second hour here. And then we rallied, came really close to a measured move of 2 times the range, and eventually got there, right there. So bulls, they can buy, and then I think they get out below 26, and then somewhere they have to buy again, somewhere in here. And if they got out during 34, they buy again above 35 or 36. And where do they get out here? It's not really clear. You can get out a couple points below any bar, but if you do, you buy again above the doji 43 or the bull bar 44 because it's a wedge 1, 2, 3. And then I think bulls get out below 44, 46, 47. Bears go short. But if the bears go short, if they probably get out above 49, possible second leg trap, leg 1, pull back, leg 2, or they get out after 3 or 4 bull bars up. And as far as doing anything in here, it's all low probability. If you're buying above a bar, selling below a bar, you know you're taking a low probability trade. Surprise, 59, probably going to go at least a little bit higher with 60, 61. So you can buy above 59, you can buy above 60, taking a chance that we rally above the open of the week. And then where do you get out? Unfortunately, if you're long up here, it's a micro channel, 1, 2, 3, 4, 5, 6, 7 bar bull micro channel. I think you get out a couple of points below any bar at this point. Bears can sell maybe below, I said 69. This is actually, it's hard to read that. That's actually 66. Bulls, I think they get out a couple of points below 66, maybe 3 points below, or they get out below 67. Bears, they can sell 67 or 68. And if they do, they probably get out. They certainly get out above this bar. And then how do they sell again? Unfortunately, they have to probably sell again below this bar. And that's not that easy. Or they wait for consecutive bull bars and sell a pullback for a second leg down. But you can see, even doing that was pretty difficult. Limit orders, probably sellers above 3, sellers above the 4 low right here, sellers above here, and sellers above 11, buyers below but are never triggered, buyers below here, probably sellers above this bar, 23 during 25, buyers below, but I wouldn't take that buy. If you are taking the buy below 26, better to buy the breakout point. Buyers, probably buyers below, but really tough to do. And buyers below here, but we could easily get a couple of legs down. So it's a little better to probably look to buy closer to the moving average. Sellers back to the breakout point, but with the open of the week, that's a pretty tough sell. And then I thought buyers below here, sellers above, and then really tough to do anything. Better to wait for the breakout consecutive bull bars, probably buyers and buyers below, but buying below 64 is rather dangerous. It's a triangle late in a rally, so possible final flag. And you can see we didn't even get a measured move up of the range before we reversed down. And not really any great limit orders through here. You could argue selling the close of 74 after 75 to follow through, so selling a pullback here for a scalp, but that's pretty tough, especially this late in the day. Or buy the close, sell the close 7, 8, 9. Selling the close at 10, not ideal. It's a big bar, and there might be more traders buying the close for a scalp, but if you sell it, you can better if you can scale in. And 15, not really a good sell the close. If anything, I think it's better buy the close than sell the close. Buy the close 20, 21, even 22, but you're right at the moving average. If you're buying 22, you definitely have to buy a pullback, so you need to trade small and scale in lower, which means it's probably better just to forego the first entry and look to buy lower. Buy the close anywhere in here, but tough to buy, tough to hold long through 35, and then tough to buy 36. But it's probably the right thing to do. There should have been sellers above, and then there was follow through on 36 due to the trapped bears down here. So probably an okay buy. And then what about selling the close at 48? Not really tough. If you did sell the close at 48 and then you saw 49, 50, 51, I think it's better just to take your loss and move on to the next trade. Probably buy the close 60, maybe 61 for a scalp, but really tough to lock in anything up here. And maybe sell the close here, but if you're selling the close at 69, you're selling right at the lows of a double bottom, and you can see how deep the pullback was. This is classic trading range price action. You get a big sell-off, and before you get the second leg down, you get a retest of the breakout points up here, and then you get the second leg down. Big bear bars before you get the second leg down. Let me do it like this. You have a rally, and it's strong enough for a second leg up, so probably buyers below. But the problem buying below is there's bulls who bought here during 66 and scaled in lower to 69. They're trapped, and they may use 72 or 73 to sell out of longs. And when you start to get 74 and 75, where a lot of traders are trapped, those traders will probably exit above any bars. And that's what happened here. That's why there's sellers above and at the breakout point, 73 low. And that's what led to 78. Let me take a look at questions. I have to look at a 15-minute chart. I'm trying to remember what I did. I mentioned I bought it here during, this is crude oil. I bought somewhere around 745, scaled in lower, made a profit, and I sold a pullback here, scalped out, around break even, sold, scaled in, scalped out. I think that's the only thing I did on crude oil. I thought about buying below, but I was too late. And I debated selling the close, but decided against it because of the moving average being far away. I bought the close here on a pullback, scalped out. And then I think I bought on the way down, and then I held for a test. I think I bought on the way down, added on above the bar, took part off here, scalped out here. And I'm trying to remember what else I did. I think I bought somewhere up here, scaled in, and got out somewhere in this area. And I think I bought once for a scalp up here, and sold once for a scalp here, and I think that's pretty much it. And I think I sold a pullback and got out a little bit better than break even over here. But stuff to remember at the end of the day. Question, what would you do if always in short suddenly became always in long? Well, it depends. When you say sudden, I think it varies on what you mean by sudden. Let's find an example. So here's a good example. Always in long, and then you get this big bear bar. It's always in short for at least second leg down. However, what's the issue with this? Here, bull bars, but is this undoing? Is this bear bar here? Is this bear bar here undoing the gap down? Not necessarily. It may just be a breakout and a deep pullback followed by a trading range. What about this? Bull bar, but this is not clearly always in long. It might be always in long. However, when you get one big bull bar and then you get a pullback, usually it's better to exit below a bar, possible second leg trap. Leg one, pullback, leg two, plus tight bear channel. I want to see something actually on that. I'm not finding what I'm looking for. But this is an example. Think you're always in short and you get a big bull bar like this, chances are you're going to get a second leg. Now what happens, what's common, I'm going to turn the screen off for a second. I want to check something. Here's what I'm looking for. Here it is. This is, I think, what you're talking about. When you're long and something clearly changes the always in direction, you just get out. And it doesn't matter what your thoughts are. You exit. It's that simple. Here, when it's always in long and you get a big bear bar followed through below the moving average, you just get out and take, it doesn't matter where you got in. It doesn't matter if you got in here or here. You just go flat. Big bear bars here, but not below the moving average. That could just be a trading range. And this is common. And this happens a lot in tight channels because it's just simply a pullback and a higher low that leads to trend resumption. Here, we've had that several times over the past couple of days. Let's take a look at a few. Big sell-off, but if we go to a 15-minute chart and look at this right here, bar 48, which is 12:30 in Central Time, it's just one bar. If we go back over here, bar 39, 11:45, should be this right here. That's 11:45, but it's just one big outside bar in a very tight bull channel. So for me, always in long and how you treat always in is really dependent upon the overall market context. Here, on today's chart, I thought the overall issue, this is what I thought the overall issue was. We had a bull channel here in a trend line break. But remember what I said over here? It's a bull trend line break. I thought the odds were we would need a retest. So the bulls need a higher low. They need a major trend reversal. The bears need a major trend reversal. And you see what happened? We rallied back up to the 50% area. And now the market's deciding on what to do. You can see how we're starting to go sideways here. So we had a deep sell-off. Let's look at a 15-minute chart. We had a rally, trend line break, and then we're retesting 50%. Strong enough rally here, second leg up. Now we're starting to go sideways. So what do you think is going to happen tomorrow? We're probably going to be more sideways. The bulls, what do the bulls want? The bulls want a double bottom and then trend resumption up to 5,000. What do the bears want? The bears want to sell off, pull back, second leg. So if we think about it from this perspective, here's the high, here's the low. Let's think about what a likely target would be. One target would be at the midpoint of the overall range right here. As you can see, we could rally all the way up here, form a double top, and then sell off all the way down here. The bulls want to rally, pull back, second leg up. So that's one possibility. I think more likely we're going to go sideways. We have a high one, so a breakout, pull back, buy setup here, and we'll probably try and trigger it tomorrow and go mostly sideways. Anyways, as far as back to your question, how do you treat always in long, always in short? It depends on context. Here we had a sell-off and then a rally, more likely to be a trading range. But then we started getting above a lot of bull bars. It was always in long, but it was always in long in what was likely to become a trading range today. And because of that, I'm not too eager to be, I don't want to buy too high. And that's why we had a lot of trading range price action here. You can see traders that sold here and scaled in, they ended up getting pretty much out down here. Let me look at more questions. Would a test of a 14 high be considered a major lower high? Yeah, I mean, it's a major lower high by definition. But I thought the odds were, where my cursor is, I thought the odds were pretty high. We were going to get back above the 14 high. And for several reasons. One, higher time frame support and resistance. As I mentioned on this chart, rally, trend line break. Therefore, the 14 high is down here, and we were likely to get a deeper pullback than that. But the other is consecutive sell climaxes. Every time you get a sell climax in a reversal attempt, there's a higher risk or an increased risk of a deeper pullback. And that's why this happened right here. Okay, looks like that's it for questions. So where do we go tomorrow? Remember what I said, inside bar, we have a high one buy above today's high. I suspect we'll probably try and trigger the buy, pull back, and then if the bulls are lucky, we'll get trend resumption up to the 5,000 round number, but we'll see. I'm going to check the euro dollar before I end this. Euro dollar followed through selling, but a big tail. Consecutive bear bars, probably strong enough for a second leg down. So the bulls, the bears are hopeful that this is going to lead to a successful bear breakout below a bear channel and a measured move. So here is leg one, pullback leg two. Measured move from the high to the midpoint of the gap takes you down here, which is also right around this big bull bar here. So overall, probably a small second leg down, even if tomorrow's a bull bar. Now, if the bulls are really lucky, they'll get a strong reversal bar. But I suspect the bulls who bought up here and more lower are disappointed, and that will probably lead to sideways trading. Not a great area to sell, though. You're selling at what could be a double bottom. Okay, thanks everybody for watching, and I will talk to everybody soon.